And here we go. Okay, this is gonna be so much fun. And thank you everybody for attending and everybody that will watch this later, because yes, it is very early, especially for you fantastic people on the West Coast. So I just wanted to give a little summary. I'm going to give a tiny summary before Tyler starts on each top of the hour, but this is a bit more of an overview. So this is the fun stuff. You guys sent in the stocks. So now Tyler has a total of 15 portfolios, and we're gonna do 4 or 5 each hour. And today we're gonna attempt to sum up all of our vlogs, actually, that we've done on the way people should look at their money and their assets. And this is the culmination, your portfolio. Your portfolio is the culmination of all these things. What you wanna get in the future, what you've lost in the past. So again, a portfolio really is a snapshot in time. When you're listening to us, you know, when you total everything you have, this is your portfolio. So again, today we're going to talk about a lot of misconceptions of portfolios, assumptions people make about how difficult they are. And by the end, we're going to show you just how simple they actually are in reality in comparison to what you've been told and what you've been told to believe. It really is simple. So we're going to do these 3 sections, each 1 hour, and we're going to start by looking at the random portfolio again that we built by everybody's stocks that you sent in. There's been a lot. It's very interesting, and we will analyze that portfolio against all other possible portfolios, including Berkshire Hathaway, which is a portfolio, the S&P 500, which is also a portfolio, various mutual funds, closed-end funds, ETFs. All of these are portfolios. And we are going to show how one small change can change your entire portfolio completely. I promise I will get them off. And just really quickly, in the first hour, we're gonna cover, moreover, how portfolios are constructed, how and why they're different, how and why do their risks and rewards differ, how do cost, fees, and slippage affects your total returns. I apologize. What are the effects of distribution, and what resources are available to inform you? So with that said, Tyler, all you.
Great, thank you very much. This is going to be very interesting for me, putting it all together over the last couple of weeks allowed me to think about what we've produced for you in the past, and some of the things that we've concluded. It's very difficult in 1 or 2 hour blogs or in a very short number of characters on Twitter to be able to explain these concepts that are unbelievably complex to most people, but there's always a simple way of doing it. And we tried to simplify a lot having to do with the investment space. Now, in our last webinar, we talked about a thing called consensio, which is a very simple concept having to do with being able to identify if something is in a trend, and if it is in a trend, more importantly, at what point and under what conditions it moves out of that trend into an opposite trend, a bull trend into a bear trend, or a bear trend into a bull trend. And I have said, since we've started these, Leah and I, back in February, that one of the most important concepts I've learned in 40 years is the idea that the trend is your friend. But that sounds kind of cutesy until you really begin to understand what it means. That everything that you value, not just in terms of dollars or lira or pesos or pounds, but everything that has value to you changes over time. And it can be things like intellectual property. And I don't mean by that the legal sense, but what you have learned, what you have perceived, about the world around you, how you understand it differently than everybody else in the world. That is one of your greatest sources of wealth. I've always believed that substance is really idea. Substance is not things. It's not money. It's not houses. It's not cars. It's not the chair you're sitting on. All of those things have come from ideas, perception, understanding. And as your understanding grows step by step, that is a trend. That little gem in your treasure box trends. It trends very quickly in the early years when you don't know anything, and so everything is new to you. It receives a boost when you start going to school and interacting with other people and with teachers that attempt to pass on ideas and concepts and perceptions to you. But mainly, it's just through you being aware of things around you. And you turn that off sometimes, you turn it back on, it trends up, and you learn a tremendous amount. It trends down and you forget a lot of what you had learned before, or you ignore it. But that's a very valuable part of your portfolio, your personal portfolio, as are all the other intangible things in your life. Friendships and family and metaphysical leanings, thinking about things bigger than what you can see, feel, and touch, but also all the things you can see, feel, and touch, all the things that make being in this world what they are, which can be trending as exciting and fulfilling and a repository for things that you give to others, to the world, ideas that you're working on that no one else has thought of before, and you at first think they're foolish, and then you realize maybe they weren't so foolish. All of those things trend up and down, and you're in control of all of those things. You don't know it, but you are. You can turn them on and up and speed them up. And all of that is within your purview. When we get to material things, things that we want, things that we work for so that we can get money to do things that we couldn't do seemingly without money, without wealth, it becomes not as fluid as what I've just described. It becomes a barrier in a lot of ways. You feel that you're missing out on so much of life by having to spend so much time working, sometimes for things you want to be working for, but many times for things you don't particularly want to be working for. But you have to in order to pay the rent, buy food, help your family grow, whatever it is. There's this tugging between the freedom that your portfolio really gives you and should give you, and the difficulty in getting the things that you want to put into that portfolio in a material way. Now, that's a bizarre opening for this particular webinar, but it's an important one to understand as we begin exploring exactly how all of this ties together with the idea of simplicity in understanding where you are, where you came from, and where you're going in terms of lines and trends, as well as in terms of probabilities and possibilities. Today, we're only going to be talking about the most mundane of all of those topics, which is how much and where is your liquid assets, meaning stocks, bonds, and cash. How much is there? Where is it? What risk are you taking with it? And what rewards are you getting from it? And are you in control of it? Or are other parties in control of it? Or do you feel completely out of control? Now, Lee and I talked to hundreds of people from all over the world through phone and email and Google Hangouts. And so our perspective is very different than each of you individually. You talk to your family, you talk to mothers and fathers, you talk to some friends, maybe you talk to a broker, but you've got a very limited amount of input. I, on the other hand, for 40 years have had input from thousands of people, some very, very wealthy and some just scraping by. And usually those discussions get around to the topic of portfolios for one reason or another. Either they're wondering if I will help them manage their portfolio or give advice on their portfolio, or what would I do about this thing or that thing. So what they're trying to do is synthesize all of their questions into input from one person or another person, or one book or one concept, or listening to Warren Buffett, or listening to Benjamin Graham, or whatever it is, taking all of this disparate information and making it real for you personally. What does it mean to me? What can I do about it? A lot of people think that I oversimplify everything. And I hope that's true, because that's what I try to do. That's what I do in my own mind. I try to take very complex topics and get to the essence of what they're really trying to say. And in doing that, I miss a lot of details, because I'm going for the essence as opposed to the periphery. But that's just the way it is with me. And sometimes people find that helpful, because it helps them through metaphors and adages and aphorisms to picture what they thought was complex, so they can realize it wasn't so complex. Okay, that's the introduction. Now we're going to go into the meat of what we're talking about. Number one, we want to be able to understand trends of things that we believe are assets in our life, or assets that we want to get. We want to know the trend, because if it's going up, we don't want to wait too long to get involved with it. And if it's going down, we don't want to wait too long to exit or get out of it. Whatever it is, a bad habit, a good habit, a great book, a lousy book, a great movie, a lousy movie, a good friendship, a lousy friendship, whatever it is that we perceived as being something of value, you want to be able to make decisions about that. You want to open your eyes and understand what you thought was valuable about that thing. And that means Apple stock or Tesla stock. It means gold. It means Bitcoin. It means the whole crypto space as opposed to other spaces. we put a certain amount of value on that, and to the extent that we value it, it becomes part of our portfolio, either in essence or in reality. In essence means you think about it all the time. Maybe you haven't actually acted on it, or maybe you're on the outside waiting to get in, but you still think about it all the time. So it occupies space in your consciousness. Today, in the next 2 hours and 45 minutes plus another hour of questioning, we're going to look at 15 different portfolios. One of them you gave to us, you being the collective you who sent in individual either stocks, in some cases ETFs or mutual funds, sometimes cryptos. And we just took those to point out what we call a random portfolio. A lot of what you might have in your life is random because you didn't really think that much about it. You bought something and put it in a brokerage account because a father or mother or friend or husband or a wife, or you yourself read something and you said, that's a good idea. And that was a year ago or 3 years ago or 5 years ago or 10 years ago. And it's just sitting there and you're not sure why it's sitting there. Or you're in a retirement account and you had to check a box. And so you talked to a couple of people and you said, okay, I'll check that box. And now it's been a year or 2 years or 5 years or 10 years, and the box is still checked, but you're not really sure what it's doing or why you did it. Those are random portfolios. They just kind of occurred. And when you think about your own portfolios, and now we'll get away from the ethereal and esoteric and just talk about things related to money and wealth and what I call liquid assets, stocks, bonds, and cash, as opposed to illiquid assets such as real estate and paintings and rare books and numismatic coins and Chinese ceramics and race horses and cars and on and on and on. That's a different topic. They are part of your portfolio, but they're not liquid. You can't do things quickly and efficiently with them. You can enjoy them or you can despair that you have them, but you can't do things quickly. And what we have been talking about are things that you can do quickly over the last 8 or 9 months that we've been doing our vlogs, including crypto and Bitcoin. You know how frustrated I am at how difficult it is to act quickly in the crypto space because of all the barriers that have been built up, the walls and the barbed wire and the codes and the special handshakes and the winks and the nods and all of the nonsense that goes in this crypto space makes it very illiquid in my mind. That's why I'm interested more in the things that I can move into and out of quickly and efficiently, like GBTC and hopefully other things like that in coming months and years. At some point, I know the technology will catch up with the dream that is crypto, and it will become efficient, and we'll get rid of a lot of the nonsense, and we'll get back to the basics, which will be Bitcoin and blockchain, and we'll be able to, with the snap of a finger, move it, keep it, store it, with absolutely no risk to it. None of that exists today, but it does in the things we'll be talking about, which are stocks, bonds, and cash. The great majority of your portfolios should always be in stocks, bonds, and cash. Always, regardless. And we're going to look at that today, how you put that together so you're never at greater risk than you want to be at, and that it won't take you tremendous amount of time to do it. So with all of that, we're going to look at our first portfolio. And this portfolio is just a grouping of stocks. So to do that, I need to push a couple of buttons, hopefully not too many. And let's see what we get here. Let's start with this one. And then let's go to this one. Let's do that one. Let's do this one. Okay, I assume everybody can see this. Now, along the way today, I'm going to be giving you resources to use for yourself. If you don't get the name or catch it, there'll be a number of them throughout the morning or afternoon or evening. The first one is just called the Portfolio Visualizer. Portfolio Visualizer. And what this is this is a way of putting together portfolios and then testing to see what would have happened over various time periods with that portfolio. The wonderful little free website, and all of my charts today come from that. So let's look at the first one. This first one we're going to look at runs between the year 2009 and 2018. So we're going to look basically at the last 10 years. Now 2009 is an interesting year because that's the end of the recession, the end of the bear market in stocks, and the beginning of the recovery in real estate. And we're going to look at the last 10 years. We're going to put together a portfolio of $100,000. And we're going to take 10 of the stocks that you sent to us. We actually got close to 75 stocks, but many of them were duplicates. Some of them we couldn't put into this particular piece of software because their time on Earth wasn't long enough. I'm going to be looking at long time periods, and so I need examples of things that were around for that whole time period. A number of things like TAL Education didn't quite make the cut. Others, there were foreign stocks, the database couldn't hold those. But what I tried to do with this first one is a number of people gave us these 10 stocks. This is GE, IBM, NVIDIA, Intel, Berkshire Hathaway, the Spiders, which is the S&P 500, Procter & Gamble, Caterpillar, Google, and BlackRock. At least 2 people gave us those. In some cases, 4 or 5 people did. So this is a portfolio that's equally weighted at 10% of each of these. And you can set the parameters. I won't do this every time because we have 15 of these to go through. But you can set the parameters. I'm going to compare this portfolio, which is a random portfolio in that people just sent them in and people didn't talk to each other about what they were sending in. It turned out to be very popular stocks, and that's what you would assume. But in this case, we're just picking 10 of them out that were named more than once. And we're starting with $100,000, and we're going to rebalance the portfolio annually, which means we're starting with 10% in each of these positions. And at the end of each year, the portfolio rebalances itself back to 10%. So if one of them has gone from 10% up to 15, that means that another one must have underperformed. And so at the end of each year, we simply go back to 10%. You can do this monthly or quarterly or not do it at all. I just chose once a year just because we've got some interesting things to look at about portfolios. Okay. Now, if we come down to the next section, this piece of software analyzes. And what we're looking at here is how those stocks can be grouped into large cap value, 36% of them, large cap growth, 40% of them, mid-cap value 16%, emerging markets 1%. And over on the other side, it shows the same thing for the Vanguard Index 500. Let's see, can I move this little picture guy? Yeah, I'm going to move it up here. I'm tired of looking at myself. Okay, the Vanguard Index 500, which is just the S&P 500, very low cost at Vanguard, it's got a little bit more, 46% in large cap value and 53% more than our portfolio. We've only got 44%, but it doesn't have any mid cap. And it's just got a smattering of some other things. Okay, so let's take a look at what happened. Let's look at the annual returns every year of our model portfolio versus the S&P 500. And what we see here is that our portfolio grew from $100,000 to $470,000. And the Vanguard Index 500 grew from $100,000 to $364,000. Are you kidding me? How is that possible? Everybody has told us for a very long period of time that you need to buy an index like the S&P 500 or the Dow Jones Industrials or the NASDAQ. And we, with one simple experiment, have just beat the pants off the S&P 500 during a bull market that lasted from 2009 up until the present time. And as you go across all of our positions, it will tell you year by year what they contributed or subtracted from the total. And you can see they don't all go up. Some of them go up in some years, some go down big. Some go, here's one that doesn't go down at all, which is the spiders. The S&P never went down on a yearly basis during this period of time. And yet we ended up beating the pants off of it through a random portfolio picked by our brilliant viewers. Okay. I am going to not go through all the details of what you can do here, but if you can see here, there's a summary, and the summary breaks down to make sure that we see that we've got 10% in each of our positions. It gives you the conclusion of final balances, 470,000 versus 364, gives you all kinds of standard deviations, best years, worst years, all that sort of stuff. It's a great little piece of software. A lot of fun. You can do it yourself, put your own stocks in it, and go crazy. All right. That's not what we wanted with a random portfolio. That's only 10 stocks. And that, to me, 10 against 500, you could easily say we were cherry picking. We built it ourselves. We took the best of the stocks. So now let's go to portfolio number 2. And to do that, I'm going to move this funny thing down here. And then we're going to go to the second portfolio. Now, the second portfolio is different because now we're going to go through 20 stocks that you gave us. In other words, we're adding 10 more. These are the stocks, and we're putting 5% in each one of them. Again, equally weighted. There's some new ones on this list. Teva Pharmaceutical, General Electric, Walt Disney, Southwest Airlines, Micron Technology, Caterpillar, Alphabet, Ryder Systems. So these are, again, stocks that you have given us. Instead of 10, we now have 20 at 5% apiece. So let's take a look at the good stuff again. This is what you really see when you look at the details of what this software shows you. Here is what this portfolio has done visually. Again, this is the Vanguard Index 500, and this is our portfolio. Again, beat the pants off of the Vanguard S&P 500. Now, remember what we're looking at. We are looking at a bull market that started in 2009 and is still going on today. That is a trend. In that trend, we looked at 10 random stocks, then we looked at 20 random stocks. We've never sold any of them. I would have sold on several occasions 10 or 15% of the portfolio into cash, because as you remember, there were some difficult periods in 2011 and again in 2015 and over the last 8 months in which a portfolio manager, yourself, if you're managing your own assets, could have monkeyed with these numbers. We're not monkeying with the numbers, we're just building portfolios. We will monkey with the numbers in the second and the third hour. These are static portfolios. This is a dream come true to John Bogle at Vanguard. But what we're not doing is using his indexes or other indexes. We're building our own portfolio, and we're doing it by throwing darts at the Wall Street Journal. Now, hopefully, you didn't just throw darts at the Wall Street Journal. What you did is you gave it some thought, and you said, well, I think this is a pretty good company. I'd be interested to see what Tyler says about it. Or you said, this is a crummy company, and I would never own it if I had to, or it was good in the past, but it's not going to be good in the future, so I'm going to have Tyler throw it into the random portfolio. Whatever your method of sending us a stock is, we see what the results have been already by looking at 10 of them, which were in a sense random in that we had to have at least 2 of you send in those names. Now we're getting a little more random by looking at 20, and we see the same results. We're not going to analyze the results other than looking at the beginning and the end, because we've got a lot to cover today. But I do want to congratulate you on your brilliant stock picking. And we will talk about that in detail as we look at brilliant stock pickers and how you can follow them. People like Warren Buffett and people like Bob Rodriguez, who most of you haven't heard of, and a number of others. We're going to look at their abilities to build portfolios and how easy it is for you to let them build the portfolios for you. Okay. We're going to jump to the third portfolio, which is really the key. This is the one that comes the closest to what we asked you to do, because here we're going to use 30 stocks, all of which you sent in. There's a number of new ones on this, including ETFs like the EWZ, which is the Brazilian ETF, Walmart, Colgate, Shaw Industries, just a bunch of them, plus all the ones we've seen in the first random portfolio of 10, they're all in here. The second portfolio of 20 are all in here, plus we've added 10 more, so 30 altogether. And we've got 3 1/3% of each until we get down to the bottom. I went to 3.34 just to make it come out to 100 without spending a lot of time on it. I don't think anybody's going to mind that last 1/100th of a percentage point for Deere, Caterpillar, Southwest Airlines, Ford, Amazon, Apple, Disney, General Electric, Intel, Teva Pharmaceuticals. Okay, so that is the portfolio. All the other setups are exactly the same, but now we're going to take it back and we're going to go to 2007 through 2018. Why did we do that? I want to start building on the concept that you can ride through bear markets 2007 and 8 and bull markets 2009 through today in the same portfolio, and you can compare it to the S&P 500 to see what would happen if you don't touch anything except rebalancing once a year. So let's take a look at the summary page. And on the summary page, we see that once again, our portfolio beat the pants off of the S&P 500. We were up 337,671 as opposed to the S&P 500 up 251,095. Now, you'll notice that the final balance is not higher than in our previous two examples because we've added a bear market at the front of it. For the first 2 years, and let's just take a look at the yearly returns of this portfolio. And you'll see in the first year, oh, that's right, I'm sorry. We reset, we wanted to go from 2007, but this software reset it. They took one of the time period was automatically adjusted based on the available data. July 2010 through October 2018 because of one stock in the group, Tesla. Tesla wasn't around before July 2010, and because of that, the entire portfolio begins in that year, July 2010, the month July 2010. It starts everybody at the same place, so you don't get noise in the portfolio. I wanted to try to go back to 07, which I will do in a lot of our other examples. But I had to cull out those things that weren't around long enough to fit the parameters. In any case, we still beat the pants off of it. But look what happened in the first year. Our portfolio was down 7.5% in 2011. 2011 was not a very good year in general, and the S&P itself was up 2%, 1.97%. So we're starting off with a little bit of a drag, and a lot of that had to do with very particular items in 2011. Look at First Solar, which is in our portfolio. It was down 74% in that year. But we didn't change it, we didn't sell it, we didn't make any decisions, we just kept it as a element in the portfolio. SEI was down 26%, Lumber Liquidators was down 29%, Advanced Micro was down 33%. In 2012, the overall portfolio was up 19%, but you can see parts for Solar again lost 8%, and Advanced Micro was down 55%, and so on. But the important thing is a portfolio that you constructed randomly over various time periods with various stocks in that portfolio, all the way up to this one with 33 different positions, easily beat the standard, the S&P 500. Now, we could bring up something else to compare it to, the Dow or the NASDAQ, and obviously we would get various relative performance. This is not today about relative performance. It's about absolute performance. What's important to me is the growth of assets, not the growth of assets relative to something else. And that is a very important concept. You're not playing a game. I had to play a game against other money managers as an institutional money manager. We had to beat everybody else quarter by quarter by quarter all of the time, or money would be taken from us and given to someone else. That's not what we're doing with your money in this portfolio analysis, your assets, your things of value. We're showing ways to look at them so that during trends that are up, you can take advantage easily. It is not a difficult thing that we were doing here. We did it randomly. I would not suggest that as the best way of going forward. So we're going to analyze the best way of building portfolios for up markets, choppy markets, and down markets. And we're going to do it very easily, just as we did this very easily. Okay, we've actually eaten up 45 minutes. And I'm going to walk away from the random portfolios now. Anybody that wants any of this information, I'll be glad to give you the list of the stocks that were sent in and that sort of thing. But for now, I just wanted to demonstrate how remarkably easy it is, where bull markets make everyone a genius. And when you've got a lot of very smart people to begin with, even random acts of kindness can result into some wonderful things during a bull market. Okay, now we're going to start doing some strange things before we end the first hour. And we're going to begin to examine the generally held concept that the S&P 500 is something sent from heaven. It's some special configuration that is the penultimate of the investment world, which is absolutely ludicrous on all levels, because it gets people to thinking that they don't have to understand that the trend is your friend. You can own lousy random stocks and beat the S&P for the rest of your life if you only do one thing. You follow Consensio, you allow a trend that is going up to go as far as it's going to go, and then you get the heck out of it as it goes the other direction. The S&P will never do that. John Bogle will tell his people at Vanguard and his clients, never do that. It's impossible to time markets. Technical analysis does not work. It's voodoo science. We spent 3 hours with you explaining very simply how 3 simple lines that you can draw on a chart will always get you out of a bull market before a bear market starts, and will always get you out of a bear market before a bull market starts. So now what we're going to do is we're going to analyze the S&P 500 as your standard. And we're going to do it by using other things and comparing over time periods those other things. We're going to start with these things called ETFs, exchange traded funds. I'm not going to go into a lot of details, except when we get to closed-end funds, because we're going to talk a little bit about GBTC. But you know what an ETF is, and it's called an exchange-traded fund, and it's a set of, let's call them random securities put inside of a basket, and they will not change that basket. Just like what we did with our random portfolio. We could take those stocks that you gave us. We could go to a company that builds ETFs like Guggenheim, like Invesco, like Vanguard, like Fidelity, and say, we'd like you to put an ETF wrapper around these stocks in these proportions, 5% each, or 3 1/3%. There's 30 stocks. And we could take that public and people could buy or sell it. We already know it performs wonderfully well. It's a brilliant group of stocks. Well, that's all an ETF is it's a wrapper around a set number of securities that don't change. From when they were first issued until they go out of business because of lack of interest in that ETF, what's inside it stays the same and is rebalanced, usually as short as each day, sometimes each week, sometimes each month. We did it yearly. We could have done it a lot of other ways. Here's the rebalancing. We could do it semi-annually, quarterly, monthly. We can do it within bands of 5 to 25%. We just took the easy way out. We're rebalancing once a year, bringing it back to what we started with. Okay. And we're comparing to the Vanguard Index 500. That's the only things we're doing, keeping it very, very simple. What I've added here are other indexes in the form of ETFs, the QQQs, the diamonds, and this one is the VEUs, which is a Vanguard total market index of everything in the world except the United States. You could pick any 3, any 5, any 10 you wanted. I just picked these 3 because I know the diamonds tend in a bull market, the Dow Jones Industrial tends in a bull market to underperform the S&P 500. And I won't go into why, but that tends to be the case. The Qs over the last 3 or 4 cycles have tended to outperform the S&P 500. So we've got one that has tended to outperform, one that has tended to underperform, and then this random thing, everybody else in the world without US stocks. And let's do 3 equal pieces of 33, 33, 33, and just see what happens. Well, what happens is we basically match the S&P 500 over this time period. And what was the time period again? It started in 2007 it started January 2008, which basically is the beginning of the bear market. 2008 through 2009, there wasn't too much damage in 2007. And by the end of 2009, it was over. But anyway, we're starting off with the guts of the bear market and then going right up through today. And we're using the Vanguard FTSE All World except the US, the SPDR ETF, and the Invesco QQQs. Okay. And in equal positions, the Vanguard S&P slightly outperformed. We did 221, 229 for the S&P. Well, if we did 221 and we know, let's take a look at the parts by looking at the annual 2008 we lost more than the S&P. 2009, we gained more. 2010, we gained more. 2011, again, bad year. We lost a little bit. S&P was up a little bit. About the same. S&P beat, S&P beat, we beat, S&P beat, we beat, and S&P. So back and forth, pretty much mirroring each other. But obviously what must have happened is part of our portfolio, the NASDAQ, probably outperformed, and the Dow probably didn't. We know the world didn't do it, so they tended to be drags. But what I've just demonstrated is you don't need the S&P. You could have picked out a couple of other indexes and even thrown in something that didn't perform particularly well, the world, over that period of time. I'd be interested to see I'm going to take a look at exposures, no, metrics, no, monthly returns, drawdowns, no, assets. Yeah. Here's the problem right here. The Qs were up 12.76% per year. The Dow was up 8% per year, and the world was zero. But when those three things were put together against the S&P, they all offset each other. And we really created an S&P out of the Qs, the Dow, and the world. Doesn't seem like we should be able to do that. I had a hunch that we would be able to, and we came very close. In a way, those are three random portfolios, and all you had to do is pick indexes. And you did the same as the S&P. And how difficult was it? It wasn't particularly difficult. Okay, let me summarize, because what we're about to do in the next hour is we're going to take a look at the best of portfolio builders by looking at Berkshire Hathaway. And we're going to compare Berkshire Hathaway to a lot of different things over various time periods. And I'm going to make some comments about the best of the best, because the best of the best is not always the best of the best. Warren Buffett will go through periods of time that will last for years in which he'll underperform. I will show you a number of managers that have beat Warren Buffett for the last 20 years, easily. And there are people that you can invest with easily through mutual funds and ETFs and other things. I don't do that to discredit Warren Buffett. I believe he's the second best investor of all times. The best investor is Jim Simons, who ran Renaissance Technologies for years. I've told you about him before. His numbers are staggering, and he uses algorithms and math, basically technical analysis in digital form, to do all of his analysis and reasoning. Whereas Warren Buffett, the number two man, who basically has been able since the 1950s to beat the pants off of everybody else in the world through his brilliant fundamental analysis of companies, came about it from a completely different way. I believe a combination of both is the best way to proceed, but I will always give precedence over the technical when making my final decisions. So with all of that, I'm going to take a bit of a brief pause, and then we will come back And what I will do right now is I'm going to, without losing all of my data, hopefully, I am going to stop sharing. And there we are. And I'm going to turn it back over. You can all take a break, go get something to drink, walk around the house or the apartment, and I will be back in just a couple of minutes and we will start hour 2. Thank you.
All right, Ty. Thank you, everybody. And yeah, we're gonna try to do these shirt changes so you know exactly when one, they're fun, and two, then you know when each one switches. So in this one, Warren Buffett, right? Let's take a look at how good he really is, where the weaknesses and strengths are of the system, and show up over time using portfolio analysis. So again, specifically going to be answered, because that's a high level. How do you determine which portfolios are consistent with your objectives and risk tolerance? How do you determine when to exit your portfolios? How do you de-risk a portfolio? And how do you build your portfolio from multiple portfolios? Tyler, please answer these questions.
Great. Again, we're not trying to pick on Warren Buffett. There's no way to do that. And I wouldn't anyway. He is an endearing figure. He has given so much to the investment community. But what we want to try to understand is what makes a great portfolio compared to a random portfolio. And there are a number of portfolios we can look at to do that. We will look at a number of them today with other people, not just Warren Buffett and Charlie Munger and Berkshire Hathaway. Now, why do I keep talking about Berkshire Hathaway? Everybody that knows anything about it knows it's simply a portfolio. But instead of buying just shares of stock in something, he buys whole companies. But it very often starts out with buying a minority share and then a bigger share and a bigger share, and very often having control in essence over the company because he has such big positions, 20, 30, 40, 50, $60 billion worth of investments he's got in various companies, which gives him things that you don't have when you invest in your own portfolios, because you end up with shares of stocks and yes, you can vote and that sort of thing. But my point is it's a different structure. But essentially, that's what he's done for his whole career. He's a portfolio manager, but he's less interested in the stocks themselves as the companies, and those companies are represented by stock shares, and those stock shares are all aggregated into a company called Berkshire Hathaway. So by buying Berkshire Hathaway stock, you own a piece of all those companies. Same thing with our random portfolio. Our random portfolio, if we wrapped it into an ETF or we built a corporation ourselves, and the only thing that corporation owned were shares of other companies, and that's what we did for a living, that would be very similar to what Warren Buffett does. So he's a wonderful example, and we're going to look at him over various time periods. But then we're also going to look at three other portfolios that you could have bought, single portfolios, just like Berkshire Hathaway, that actually did better than Berkshire Hathaway over very long time periods, meaning from 1990 all the way to today. And I won't give that away until we get into it a little bit more, but they are portfolios that I've put my clients in over that time period. Sometimes I've gotten out of them, sometimes I've gotten in them. Why? Because the trend is your friend. And when the trend changes, it doesn't matter how good a portfolio is, you exit it, always. Okay, so that means it's time for screen sharing again. You know what we're going to cover this hour? We're going to look at brilliant portfolio makers and the ease at which you can access them where you don't have to do any of the work yourself, and why that's a very wise idea, as long as you remember consensia. as long as you don't buy into the nonsense, the drivel that you simply buy and hold forever, because it's just too darn hard to get in and out. Silliness, absolute silliness. Okay. So to do this, we need to bring this guy up again. And we need to do this guy. Nope. And then we need to do that guy. And then this guy. I'm getting the hang of it. It's only taken me 40 years. Okay, here we go. What we're going to look at is the fifth portfolio. And we're actually looking at three portfolios here. Let's go up to the top. Let's look at the time frame. This first one is 1997 through today. And what happened in 1997? Well, nothing really. It was kind of a random date, but it's based on the fact that the QQQs came into existence. The diamonds and the spies, which were ETFs for the Dow Jones Industrials and the S&Ps, came about several years earlier. But in this illustration, what I wanted to do is I wanted to take a look at Berkshire Hathaway against the S&P 500 to show you how remarkable Berkshire Hathaway is. So what I did is we put 100% in portfolio one of Berkshire Hathaway stock. In the second portfolio, we put half of our money, $100,000, which is what I'm using across every one of the portfolios we're talking about today. They're just percentages. Therefore, if you've got $10,000 or $10 million, it doesn't matter. All of the numbers would be the same on a percentage basis. In the second portfolio, we added the Qs to our portfolio with Berkshire Hathaway. So now we've got 50% Berkshire Hathaway, 50% NASDAQ. And then in the third one, we threw in a stock that we all know has been a huge stock, but it's one that is easily accessible to most of our listeners today. What I mean by that, it's a technology stock. You're all very hip and younger than myself, probably not younger than Leah, but you know what buttons you need to push in terms of technology. As you know, I have no technology genes in my body. My son got them from my wife and my daughter got them from my wife. I don't have any. But you all do, and because you found us on YouTube or on Twitter or places where you need to know how to push buttons. So I assumed that why don't we throw in something we know has a remarkable record just to see what it does and also to offset some other things. So this is not a random portfolio. I picked this portfolio of three, Berkshire, Qs, and the Amazon. But first, let's look at portfolio one, which is just Berkshire Hathaway. So here is Berkshire Hathaway up $548,000 over that time period, starting with 100,000, going back to, let's see where this actually started. It started in 2000, which means the time period was automatically adjusted based on the available data, April 1999 through October 2018. Okay, so that's when the Invesco Qs came out in April 1999. So again, I misstated that. I built a lot of charts over the last couple of weeks. But the important thing is we started in 2000, so we've got from 2000 to 2018, or 18 going on 19 years of data. And here's the brilliant Mr. Warren Buffett at $548,000 compared to the S&P 500 of 260,000. So Mr. Warren Buffett doubled the S&P 500 over the last 18 years. But that's impossible because John Bogle and the people that say buy and hold indexes say that money managers can't outperform over long periods of time indexes. Nonsense. Absolute and utter nonsense. Erase it from your memory. Forget that you ever heard it. It's childish and silly. Okay, our portfolio number 2, remember, is 50% in Warren Buffett and 50% in something else, which was the Qs. Now that seems odd, doesn't it? That if you add 50% in the NASDAQ during the heyday of the internet, true, we're starting the year 2000 at the peak, and we had some sell-offs along the way in 2001, 2, and 3, and again in 2007, 8, and 9. But Mr. Buffett had to go through those too. But our portfolio, even though it beat the pants off of the S&P 500 because it's so easy to do, 400,000 instead of 260,000. Go away, you little funny thing. Didn't do as well as if we just stayed with Warren Buffett. That's why I threw in the clunker, the cheater, Amazon in the third portfolio. So now what we're going to do is we're going to throw one stupid stock into the portfolio, but we're going to give it a heavy weighting. Why? Because we really believe in Amazon. Wow, this thing is great. I can buy all my books there. And then all of a sudden you can buy other things there. And then all of a sudden you can buy the world there. And all of a sudden, you know, it is the largest corporation in the world. Well, you didn't know that back in 2020, but because you're young and you're hip, you picked up on it pretty quickly. You started using it. You saw its functionality. You saw bookstores going out of business all over the world. And I'm going to do a little aside on that a little later because I spent an hour and a half looking for a newspaper yesterday in the city of Chattanooga, which is a pretty hip place. And I couldn't find either Barron's or Investment Business Daily anywhere, including in bookstores like bookstores. And that's because of Amazon. Amazon's put them all out of business. But when you add to a portfolio a 1/3 position, we're going to water down Warren Buffett. We're going to water down the NASDAQ, but we're going to add this one little stock. Now, don't tell me that you might not have done the same thing in real time at some point over this period of time. And obviously, look what it does to the portfolio. It triples the second portfolio, and it over doubles Warren Buffett. By adding one stock to a portfolio, and that portfolio happens to be made up of hundreds of companies. Why? Because Warren Buffett has got 75 companies in Berkshire Hathaway, and the NASDAQ's got 2,000 companies in it. But depending on your weighting or the amount that you put into an investment. Notice what we've done in our first number of portfolios, equal weighted, 5%, 5%, 10%, 10%, 20%, whatever it is, equally weighted. We're equally weighting three things here. One of them is a single company. Now, a lot of people argue that it is no longer a single company because there are parts to it, such as groceries, such as books, such as technology that can be purchased on it, such as clothing, on and on and on. So, you know, maybe it's not a stretch to give it a third weighting, but look at what it does to a portfolio. Even if you did a 10% weighting and put the other money back in on the other side, or built something else by adding 4 other stocks to it, you know that you would have done tremendously well. True, you had to pick that stock and make that determination, and that people don't like to do most of the time because you don't think you've got the acumen to do it. You've been convinced by other people, by the media, by Wall Street, that this is such an unbelievably difficult task that you can't do it for yourself very easily and very simply. Here you did it just with 3 purchases and never touched those purchases. I've already told you that's not the right way to do it, but you can do very well just buying and holding if you buy quality and the world doesn't come to an end. Okay, so that's the first one I wanted to look at. Now we're going to look at Berkshire Hathaway in a little bit different light. We're going to look at the same portfolios, but we're going to knock off the first 7 years of those numbers. Instead of going from 2000 to 2018, we're going to see what happens when we start a portfolio at the beginning of a very nasty bear market. What does it do? We're not going to change our Amazon. We're not going to change our Qs or Berkshire Hathaway. We're simply changing the time frame. This is where a lot of you get messed up. This is where almost all investors get messed up, is how do you really calculate or understand how good or bad something is, someone is, without changing the time frames to make them perform in good times as well as bad times, or simply in bad times. Here we're giving everybody the benefit of the doubt because we're looking at what they did in good times and in bad times by looking at a bear market followed by a big bull market. Okay, portfolio 1, Warren Buffett, 279,000. He beat the S&P, but not by very much. Warren Buffett plus the QQQs in equal amount did very well relative to the S&P, almost 50% more. And of course, our little Amazon throw on beat everybody. But that's not the point. The point is Warren Buffett went from 2000 to 2018, tremendously beating the index, to a full market cycle of down first and then up to just barely keeping up. Let's take a look at what the annual numbers looked like. And you see in 2008, Warren Buffett lost 31%, which was less than the S&P lost in that down year. Warren Buffett lost 4.7%, where the S&P was up 2. Warren Buffett lost 12.5% in 2015. The S&P was up 1. Notice also that you get huge swings in Amazon, but most of them are to the upside. You also get swings, but not as dramatic as Warren Buffett did in our Qs plus Warren Buffett, the second portfolio. And therefore, the end numbers. Okay, interesting. So time matters. How you measure these things matter. The longer the time frame, the more important the measurement. Just as the longer the trend line, the more important the measurement. Okay, let's take a look at another period of time. In this case, we're just going to look at Berkshire Hathaway against the S&P 500, but we're doing it all the way back from January 1995 to December of 2003. The reason I started January 1995, let's see if they're going to throw a curveball at me here. No, they don't. Thank you. The reason I started January 1995 is 95, 96, 97, 98, 99 are the 5 best years in stock market history, with the stock market averaging over 23% per year annualized, or doubling every 2.5 years over that period of time. But I've also included the bear market, which started in March of 2000 and ran through March of 2003. This didn't allow me to break it down, so we also got the beginning of the next bull market from March of 2003 through December of 2003. But what we're looking at is a full market cycle, and let's just see what happens relative to the S&P 500. Once again, Warren Buffett is able to dramatically outperform over the 5 best years where the S&P 500 did tremendously well. And I will tell you, if you break it down by years, you will see that in the last 2 years before the bear market, 98 and 99, Warren Buffett did very, very poorly. What people don't realize is he actually wrote a letter to his shareholders, and you will see that here. This is his peak. He's the blue line, Vanguard S&P 500. The S&P 500 went all the way up until the peak and then down until the bottom before it started up again. But look what Warren Buffett did. 1998, 1999, before the year 2000, his value had dropped from 375,000 down to under 250. It looks like 225 before the market had peaked. And he sent a letter out to his shareholders apologizing for his horrible underperformance. Notice that from 1995, he held his own, actually beat the S&P dramatically in 1998. Then things began to come apart, but the S&P kept going up. What was happening? Well, I'm not going to take time to show you here, but you will see if you break down that period that value investing, which is what Warren Buffett does, went into a big decline that lasted almost 3 years and did not come back until the downturn in March of 2000 of the overall market. And the reason was because everybody was piling into dot-coms and growth stocks, mainly technology stocks, and the S&P kept moving up because of that. This move in the S&P, where there's 500 stocks in the index, came about because of 10 stocks, which were the big technology growth stocks at the time. And because it's a cap-weighted index, the big stocks have more of an influence over the price, which is what I've been saying about the NASDAQ move and the NASDAQ 100 move currently in the current situation. But what I wanted you to understand is that even though for this entire period of time, Warren Buffett did much better than the S&P 500, if we only measured from this point in 1998 to this point in 2000, you can see the dramatic difference between performance and underperformance. And once again, I point out that how you measure things and compare things in investments matters very, very much, and why the advertisements you see on television for this fund or this manager or that manager, or John Bogle picking particular time periods to say that money managers can't outperform indexes, you need to be able to look through all of that nonsense and do your own thinking about what is being said. And I don't think I could show you a more dramatic way of doing it than what we just looked at. Okay, now what we're going to do is we are going to look at the period 1995 to 1999. So we're looking at the best 5 years in US stock market history without tagging on the down years. And we're going to look at Berkshire Hathaway again, which ended up $1995. Oh, this must be monthly. It is. Which is interesting in itself. And we'll go back to that in just a second. So we're looking at the 5 best years in US stock market history. And we're comparing Warren Buffett in value investing to an index, the S&P 500. And what happens? He tremendously underperforms. When I say tremendously, $75,000 on a 350 base, so let's say 25%, which isn't quite accurate, but it's close. Okay, Now, how's that possible? Well, you know, because I gave away the answer to the riddle by saying that from 1998 to 2000, value investing not only underperformed, it actually went negative. Take a look at 1999. This is Warren Buffett. The S&P 500 was up 21%. Warren Buffett was down 20%, and thus his letter to his subscribers saying, you know, mea culpa. I'm just doing what I always do. It just ain't working out this time. A simpler explanation is simply value investing in general. It's not Warren Buffett. I could show you 250 brilliant value investors that all got their heads handed to them over that time period. But it's also how I was able to outperform 99% of all equity managers in the United States between 1998 and 2003. I was managing institutional investment accounts, and I am restricted by the guidelines of what I can and can't do. I can't raise cash. I've got to be 100% invested at all times, even though a meteor is about to hit planet Earth, or we're going into a deep, deep recession, or we're going into a big bear market, or the Twin Towers are going to be attacked. Doesn't matter. The guidelines say you must stay invested 100% at all times. That's an exaggeration. They let you raise 5% cash, and if you ask permission, you can get another 5%, but you can't hold it very long. Okay, so I'm competing against every other institutional money manager during those years, 1998, 99. Remember in 1999, what did the NASDAQ do in 1999? It was up over 80%, 80% in 1 year. We just saw what the S&P did in 1998, was up 28%, up 21% in 1999. It was up 33% in 1997. It's going on a tear. It was up 37% in 1995. By the way, Warren Buffett was up 57% in 1995 and 52% in 1998 before the bottom dropped out. Well, the simple recognition that if you were watching growth versus value, the growth began to turn down in March of 2000 and value began to turn up is all I needed to switch out of growth and into value through the rest of 2000 into 2001 and 2002, and thus outperform all the other managers, because other managers can't do what I just did. How did I do it? I build all my portfolios using mutual funds, not using individual stocks. Not a single other money manager at the institutional level does that. Out of some 2,500 institutional money managers, only one used mutual funds. And that was the firm that I was working with, Amivest Capital Management. And because of that, I could quickly, almost instantaneously on a given day, completely change the portfolio from a growth portfolio to a value portfolio without doing what the guidelines said, which was to raise cash in a bear market. And therefore, the returns were obvious. Don't tell me what to buy, tell me when to buy it. Okay, so the best of the best over a 5-year period could not outperform the index. This is what John Bogle would point to say that even the best people can't outperform this marvelous thing called the S&P 500. we've already blown that idea to bits, I hope. I hope you see how simple it is to go through this kind of analysis and come to your own conclusions about what is real and what is not real. Now, you're beginning to wonder what the heck is really going on here. I didn't want to really know how portfolios have acted in the past. I wanted to know what's the essence of a portfolio so I can build them myself, which is going to be part 3, which is still 20 minutes away. I want to give you the mental picture of what a portfolio is and how it's affected and how easily you can change it by adding just one thing to it, one stock, one other index, one other ETF. And you're going to make those decisions based on not your guesses or your assumptions or your hopes or what somebody else told you. You're going to simply use a technique called consensio, and you're going to run those 3 little lines against various things. And they're going to tell you when they're in an uptrend, when they're questioning their own uptrend, or when they're beginning a downtrend. And you're going to take action. And the action's simple. You're going to buy something that is going from a bull market into a bear market, or from a bear market into a bull market, and you're going to exit positions based on that very simple technique. Don't tell me what to buy, tell me when to buy it. The what part is easy. I've already given you one by Berkshire Hathaway. I'm about to give you several other ones, and we're going to do that right now by looking at a fund that you could have bought any time in the last 30 years and held on to it. And it's called the Fidelity Contra Fund. The symbol is FCNTX. And we're going to put the Fidelity Contra Fund from 1990 until today. So we're looking at almost 30 years. Many of you weren't born when you could have bought this fund. And here's the summary. 100% in this fund relative to the S&P 500. If you would put $100,000 into Fidelity Contra Fund, it is today worth $3.152 million. With, I will point out, a standard deviation, in other words, volatility less than the S&P 500. And that's what the chart looks like. Should you put all of your money into this? Sure. Or all your money into Berkshire Hathaway? Sure. Or I could give you 50 other portfolios that have done the same thing against the Vanguard Index 500, the S&P 500, John Bogle's baby, and you would have beat them over and over again. But I want to stress a number of things here. There are 20-some thousand mutual funds. 95% of them aren't worth the paper they're written on. That doesn't mean that they all aren't. 5% of 20,000 is 1,000. That means there's 1,000 funds you can pick where there are brilliant managers who use many techniques, most of them fundamental, but a lot of them use technical analysis also. which is the same thing that you can do if you want to. It's just that they spend 8 or 10 or 12 hours a day, every day, doing nothing but that. Well, what people like John Bogle say is, well, yeah, there are some good people. Well, that's all you need to know. You're not buying the average money manager. You're not buying the average financial planner. You're doing your basic research and you're finding those that are great at what they do. And some of them manage either ETFs or mutual funds or closed-end funds that consistently do what you want it to do. And I'm going to give you the resources to find those. I've already given you this portfolio visualizer, and here it is at www.portfoliovisualizer.com. And you just go to backtest portfolio, you build it yourself. It took me 10 minutes to figure out the whole thing. It's a great resource. Okay, what is Fidelity Contra Fund? Well, don't worry about it. It's been around for a long time. If you want to worry about it, read up on it, see who has managed it. Fidelity is a brilliant house that has now become a $7 trillion monolith who is getting into Bitcoin. They've been mining Bitcoin for the last 3 years using their unbelievable computer power in Boston and around the world. They're very progressive. It's owned by a family. It's privately held by the Johnson family. Ned Johnson and his daughter Abigail have built this incredible place. That's where Peter Lynch made Fidelity famous through the Magellan Fund back in the 1960s, 1970s. In the 1970s, where the stock market wasn't going anywhere, he was having huge returns by buying mid-cap companies and doing fundamental analysis and writing brilliant books. And if you haven't read his books, you need to. Okay, so that's the portfolio visualizer. To get information on mutual funds, I recommend subscribing to Morningstar. Now, Morningstar has gotten off into other things, stocks. You can look at ETFs, and they've got their own analysts now and stuff like that. But that's not how they started out. They started out the same year or a year after I started my company called Cannon Block Correa back in Boston. And all we did for 6 years is study mutual funds, what made them work, what are the good ones, the bad ones, how you tell them apart, all that sort of stuff. Morningstar began publishing and got a bunch of money to build a real research and publishing house. I disagreed with their methodology for the first 5 to 10 years, and they changed it over time, and I think it's excellent now. I still do it differently, and I think my techniques are better, but that's because I'm an egomaniac. But in any case, you can subscribe very inexpensively to Morningstar, Morningstar, and just Google them, pull it up. They've got different things, the pro and the simple and the free. You can do a free 30-day deal. But you can screen mutual funds all the way I'm doing all this screening here. Every way possible. You can read the history of who's managing it. But anyway, this particular fund, the Fidelity Contra Fund, is just brilliantly managed by basically the same person over most of this time. They do things in teams where they bring junior and assistant portfolio managers along after 5-10 years of working with these masters, and there are many of them at Fidelity. and you can just pull up all the Fidelity funds on Morningstar. You can pick out anything, all the Vanguard funds, every fund, any size fund, and break them down into hundreds of categories and look at all kinds of time. That's the way to do it for picking mutual funds, or you can become one of our clients and I'll do it for you. All right. So what this shows is just the tremendous differential. Oh, I was saying that Don Bogle and others say the reason is a mutual fund will never be able to outperform the index is because of the expenses and the costs. Blather, absolute blather, smoke and mirrors. The costs of mutual funds have nothing to do with the final return. The alpha that comes from a mutual fund is net of all costs. It's the brilliance of the person picking the stocks and managing the portfolio. Take away all of these figures have already subtracted out the internal expenses within the fund. And if you ever pay to buy or sell a fund, you are foolish. There's no reason to ever pay a commission or a load to buy or sell a fund. Every time Vanguard Index 500 buys and sells a stock, which they must do every time they rebalance their index, it costs money. Not very much money, but it costs money. It doesn't cost you any money to buy or sell a mutual fund if you buy a no load or no transaction fee fund, and you can do that across thousands of funds. Okay. And all of the internal numbers are taken out every day in the form of the expense ratio, so that the numbers at the end of the year have already reflected the expenses coming out. When they say it's a 1.3% expense per year annualized on the internal expenses on the average mutual fund, you picture that, oh my gosh, at the end of the year, they're going to take 1.3% away from you. Wrong. At the end of the year, see what's in your portfolio. The expenses are already taken out of it, and those show up in these numbers. 3.15 million instead of 1.3 million, just with this one fund called the Fidelity Contra Fund. Okay, we're running out of time in this hour, and I've got two more to go to. This is another remarkable group of funds out in California that actually fall under the name Capital Research and Management, but their familiar name are the American Funds. And this is one of their funds called Growth Fund of America. I've owned it for clients for years and years and years. Here's the same period of time we just looked at. If you put your money in the S&P 500 back in 1990, or if you put it into Growth Fund of America, 100% of your money in 1990, this is what happened. $2 million in portfolio one, $1.3 million in the Vanguard Index 500. This is not managed by an individual, it's managed by a team. Each member of the team has equal weighting of a piece of the portfolio that they manage. Now they all talk together, they bounce their ideas off each other, but that's the way all the American funds are run. It's a brilliant management system for building and managing a portfolio, and obviously adds alpha. Again, I could show you 50 of these. I'm just showing you 3. This one I love because this guy and his team have flown under the radar for years. The guy I'm talking about, his name is Robert Rodriguez. And the name of the family is FPA, which stands for First Pacific Advisors. And I picked out his fund, basically, which is called FPA Capital, and its symbol is FPPTX. F as in Fox, P as in Peter, P as in Peter, T as in Tyler, X as in X-ray, FPPTX. And you put 100% in that over the same time period, and he's up $2 million versus the S&P up $1.3 million, and there's his chart. Now, Bob is a very unusual guy. Morningstar picks their best fund manager, equity manager, and the best bond manager once a year, and they have a big award ceremony. Bob is the only one that won as the best equity manager, mutual fund equity manager in the country, as well as winning the best bond manager in the country. Nobody's ever done that before. He runs another fund called this is FPA Capital, FPA New Income. And I was one of the biggest shareholders in FPA New Income back in the 1980s. And then I kept buying it in the 1990s and 2000. And I got to know Bob because not very many people were buying his fund, particularly FPA New Income, because he did everything wrong, except he made lots of money for his clients. But he does everything untraditionally. In both FPA Capital, it's pure alpha, it's pure genius, it's pure not going by rules, but looking for anomalies, being completely out of major parts of the market for long periods of time. There's very little correlation between what he does and others do. Here's market correlation up here. We're not going to get into all the statistical stuff today. We'll do that at another time. But anyway, market correlation, also called R squared, basically is how a portfolio relates to some underlying market. In this case, the S&P to itself, they're giving it a 0.99. It's actually 0.999999. And the difference is that this is actually a fund called the Vanguard Index Fund, which has a little bit of a cost, whereas the underlying index has no cost itself. Enough of that. 19% less correlation, which is huge, which means that basically he is not acting. 20% of what he does has nothing to do with what the market's doing. And you can see that by the size of the moves, both up and down, that he takes at various times compared to what the market does. Just ridiculous things, because he's a genius and he's a brilliant money manager. So I just wanted to bring you a couple of those different types. One's a committee that makes decisions. One is an institution that has a tremendous history of bringing on brilliant talent and teaching them over time through an apprenticeship program. And one of them is a maverick who has been very, very successful and has brought on other partners, but it's a very tiny group, but do a fabulous job. And also his funds are almost impossible to buy at no load. because he doesn't have any marketing, so he has people market it for him. I've been able to buy them no load because I'm an institutional manager and I buy in very large lots. But I just wanted to show you definitive evidence that don't go by what Wall Street tells you is true. It can be very simple. You take a minimal amount of research on your own part, overlay it with the simplicity of something like Consensio, and you're golden. And with that, I'm going to take another small break. You can all take a small break, which means that I need to push buttons again. I hate pushing buttons. I just know that I'm going to do something wrong. Now, how do I get this thing to come up? How do I make this big so I can get out of screen sharing? I bet I could go here. Nope. Okay, Leah, you've got to do it yourself. I can't figure out. Oh, wait. Boom. See?
Genius.
I am a genius. Okay, be right back. Okay, back.
We're back, and we do have Thor eating, so apologies for a bit of noise from the hungry boy. So we are on the last part, guys. This is going to be fun. So high level, we are going to be looking at what you need to do with your portfolios in bear and bull markets, and then we're going to talk about where we are today with where you should be with your portfolios. So we're going to be bringing it to the present, and we're going to switch. Pretty much we're going to be looking at, are we switching from a bull market to a bear market, potentially contrarian, and how you should change your portfolios to take advantage of that. So in the minutia, the questions that Tyler's going to answer is, right, which portfolio is most consistent with the current market dynamics? Bull market portfolios, bear market portfolios, the election's coming up. So post-election portfolios. How often do you trade a portfolio? What are the current trends in interest rates, stock markets, economics, both domestically and globally? So pretty full spectrum. And with that said, Tyler, hit us with the last hour.
Okay, very good. Thank you. Yeah, this is the important one to me, because to get into this last hour and the questions that follow, I think we needed to spend a couple of hours summing up a lot of the things that Lee and I have been talking to you about over the last number of months through our vlogs. We've talked about trends in money management and various technical systems, and we've given you all kinds of metaphors and adages from Wall Street that I deeply believe in. But it's hard to tie it all together. To me, the concept of portfolios is what does it. And how a portfolio really works and what you should do with it, and how by tweaking it, you can completely change, very simply, the aspects of it. I look at it as a portfolio as something that is constantly changing. With every tick of the market, it is a different portfolio. And if you think about it in terms of some of the broader concepts I started with, that a portfolio is a continuum. It is not static. You think of it as static because the names of things that you put in it are static, and very often the numbers of things you put in it are static. You own IBM, 100 shares of IBM stock. And so you think of that as a frozen in time. Oh yeah, I've got 100 shares of IBM stock, but it changes every day. Its value goes up, it goes down, there are stock splits, there's interest, there's dividends. It's a real living thing, as is all of your portfolio taken together. And you can change the trajectory of that portfolio by introducing something new to it or taking something out of it. And that can be a very dramatic change. It doesn't take a lot of confusion and time on your side of the ledger. You can do it easily and quickly, but you cannot do it easily and quickly unless you understand all the principles that I've been talking about for the last number of months. And we're going to try to bring you in much more detail in these webinars. But portfolio concept is the one that ties all of the others together. And so we will continue, but we're going to start talking about the present by quickly going through a list of the type of portfolios and where you can get information about them. Now, we've talked about mutual funds and using Morningstar, but you can get a lot of that information through your brokerage electronically on Fidelity or Schwab or E-Trade or many others they'll have a mutual fund section. The best, I believe, is the Fidelity one and the Schwab one, other than going directly to Morningstar, who does the best job of analyzing. Now, in the closed-end market, which Fidelity doesn't really cover, there's an association called CEFA, C-E-F-A. And CEFA stands for the Closed End Fund Association. So if you just type that into Google and pull up CEFA, they've got analytical tools of all of their members' closed-end funds, basically. And there's about 600 or 700 of them. And you can do the same sort of analytics. And there are other places you can go. You can do a little bit of research and find them. But start with CEFA if you want to learn about closed-end funds. We're going to take a look at a couple of them in just a second. And the difference between a closed-end fund and an open-end fund, which is normally known as a mutual fund, is that a closed-end fund trades all day long, and it, like an ETF, is a basket of securities that doesn't change in general, 99% of the time. So when it's first put together, it's put together as a fund with the idea that what's in that fund will stay in that fund and may be rebalanced, maybe not be rebalanced. Maybe there's one guy in charge of it, maybe there's a big team of people in charge of it. But it is a security under the same Securities Acts as mutual funds, the 1940 Act, and it is regulated by the Securities and Exchange Commission. It's just not as popular as open-end funds for a lot of reasons. Number one, it's traded on exchange, so you've got to buy and sell it. Therefore, there's transaction fees, as opposed to no-load mutual funds, open-end funds, where there are no transaction fees. Number two, just like GBTC, closed-end funds can trade at premiums or discounts to the underlying intrinsic value of what's held within the fund. Well, why would that be? Well, it doesn't matter. It just is. Okay, why would it be? It would be because people believe that the future of what is held in that portfolio is worth paying a premium for, or that the junk that's in that portfolio is not worth paying even what anyone else is paying for, so they short it. And therefore the price goes down and there's a discount. These discounts and premiums can be huge, 40% plus, 40% minus. That's different than GBTC. GBTC can go up to 125% premium, but the biggest discount it's ever gone to is basically 1%. I think I've actually seen a 3% intraday kind of a move on GBTC. You have to break it down hourly, but forget that. The important thing is that GBTC is not a closed-end fund, but it acts like one. It's a trust that's set up as an exchange-traded product with special bells and whistles around it. It's actually sort of brilliantly designed to represent what's been around for many, many years, closed-end funds. There are some investors that only buy and sell closed-end funds. They're very good at it. They're institutional, and they make a huge amount of money. What they love to do is they like to buy closed-end funds at a discount and buy the whole fund out and capture that discount on what they paid on a negotiated basis with all the shareholders. I'm going to show you a couple of them only from the perspective of helping you understand a little bit more what a portfolio is. A portfolio can be anything you want to make it. I started off in the first hour by saying it's intellectual property that you have, it's your relationships, it's a metaphysical thing, it's a physical thing. It can be gold and silver, it can be Bitcoin, it can be pieces of paper, it can be CDs, it can be racehorses, it can be your house you live in, it can be real estate. All of that together that you have some claim over is your portfolio. And it changes. It just changed while I was making that sentence. It changed in value and will continually change. It's your duty to understand the trend of the things that are in your portfolio. I can't do that for you. Nobody else can. You've got to become aware of them. You've got to become aware of what they are, what they mean, why they're there, why you've spent time working hard, taking money, sitting in a bank because you were too afraid to do anything, then venturing out and getting burned by you did this or you did that. So you punish yourself and you stop doing it until years go by. What we're trying to bring to you is a simple way of thinking about all these things. Demystify it, because it's not mysterious. It's all very intuitive. Okay, so we've talked about open-end mutual funds. We've done a random portfolio that you picked out of midair. We've looked at some of the relationships of what people think and believe and are told about indexes and making decisions about getting into and out of and all that sort of stuff. Now we're just briefly talking about closed-end funds because it's another form of a portfolio that you can easily buy and sell. And it's fascinating. If you've got some time, you know, it used to be that you could buy newspapers that listed all the closed-end funds in them. Barron's used to do it. They probably still do, but I can't find a Barron's anywhere in Chattanooga. That's why newspapers are going out of business. I said I was going to mention that. I Googled it for Chattanooga. I wanted to see where I could buy them. I drove for 45 minutes around and around, couldn't find anything. Finally, it said Barnes and Noble, so I went to Barnes and Noble, and they didn't have a single newspaper. They had 50,000 magazines, and they had about 6 on investing and about 250 on electric guitars. It's the strangest thing I've ever seen. And on bodybuilding and on making cakes. I mean, 300 magazines on making cakes and 6 on investing. That's a telling point. I'm not sure what the point is, but it was very interesting to me. So I ended up picking up 4 magazines, Kiplinger's, Bloomberg, and I'm going to go pick up the other ones. I'll be right back. This is a great one for those of you that are interested in technical analysis. Most of you know it already. I don't know if that's backwards or not, but it says Technical Analysis of Stocks and Commodities. It's really a great magazine. And there's an article on the diamond formation, which you don't hear anyone talking about, but it goes in depth on it. It's actually a brilliant thing. Bloomberg Markets. There's a thing called Worth Magazine. There's Money Magazine. That's it, except for Kiplinger. Now, Kiplinger had an article in it, and I threw it into our analysis. And we're going to talk about that later in this hour, because they picked out 3 ETFs and 6 mutual funds, or no, 3 mutual funds and 5 ETFs. And they said, these are the ones you need to buy. We give them our gold medal or whatever it is. And so I plugged them into our analysis of portfolios just to see how good those 5 ETFs and 3 mutual funds that Kiplinger's Changing Times picked out relative to our random portfolio into the S&P 500 over various time periods. We're going to end up this hour by looking at that. But for now, closed-end funds, I've given you a source where you can look for information on them. They have tickers just like any stock does or any mutual fund does. I'm going to pull up some things now, starting with these closed-end funds by doing screen share, and I'll tell you why and how in just a second. So the way we're going to do this is we're going to share once again. We're going to go to this, we're going to go to this, and then we're going to make this big. Wow. I am so proud of myself. Okay. What are we looking at here? We are looking at here the same format. That's FPPTX. That was our, now we are looking at, okay. I picked out 2 at random closed-end funds for different reasons. One, because I know the people very well that did the first one, which is called GAB. That's the ticker, which is Gabelli, Mario Gabelli's company up in Westchester, New York. We worked very closely with them for a long time. I competed against them as an institutional money manager, got to know some of the managers there. I didn't know they had a closed-end fund, but I found it and I threw it in here. So we're going to go over a long time period, 1995, the beginning of that great 5-year run through the downturn in 2000, the second downturn in 2007, and all the way up to the present. And we're going to compare the Gabelli fund to the S&P, and then we're going to add another one, the IJR. IJR is the ticker. And we're going to break it down into 2 50s, 50 Gabelli, 50 IJR against the S&P 500. They've both been around for a very long period of time. This one is starting, it says, in 2000. So we're not going to get the benefit of that 5-year pop, but that's a pretty good run. And the reason is the IJRs, which are the small cap iShares core S&P small cap ETF, which is actually a closed-end fund by the name of IJR, and the Gabelli Equity Trust, it's called. And we see the Gabelli Equity Trust is up 340,000 with a starting 100,000 against the S&P 500. Now, what does this mean? Remember that the pieces within that portfolio don't change over time. No one's managing them. But it can trade at a discount or a premium to the underlying assets in it. So somebody that put it together a long time ago did a pretty darn good job, because it was able to beat by almost 25% the S&P 500 over that full period of time. Now, portfolio 2 included small cap. I misspoke, that isn't a closed-end fund, that is an ETF, that's the iShares Core S&P, the IJR. I decided what I would do is just see what happens over long time periods if you only had two things in your portfolio: a small cap position that you never change and that doesn't change itself. Meaning in an ETF, like a closed-end fund, it's static. There's nobody making decisions to buy this and sell that. In an open-end mutual fund, except in an index fund, there's somebody or a team of somebodies or a group of associates that are making decisions. Let's sell this, let's buy this, let's add to this. That's not true in a closed-end fund or an ETF. It's static. Well, here are two static ETF, one ETF and one closed-end fund that when held for 18 years easily beats the S&P 500, which is down here, and does it consistently over the whole period of time, which I found very interesting. Now, you can go to CETA and you can pick out various funds and compare them to other things. But just remember, the difference between the closed end and the open end is nobody's managing it. And in general, in an ETF, nobody is managing it. They're simply rebalancing it back to the way it was on day one in terms of percentages of holdings. The holdings don't change in general unless one of them's bought out or some event takes place. Other than that, it's static. But we've seen with open-end funds that are actively managed, with funds that are portfolios that are static and are not managed, they can be put together without any real problem by going back and doing a little research and finding those that consistently do well over all market periods without you getting involved, without using Consensio. Without doing a darn thing, you can beat the pants off of buy and hold S&P 500 type of things. You can buy and hold your own portfolios. I do not recommend it because I don't like going through these periods. And I don't like going through these periods. And I might very well not like going through what is beginning to look like is happening here. And we're going to talk about that at the end of this. Because I believe, besides having a portfolio that changes every second of your life, whether you get involved with it or not, there are times when your intellect and your consciousness have got to be screaming at you, there must be a way that I can avoid these big problems. 2007 through 2009, 2000 through 2003, 1965 to 1982, 1929 to 1953, and maybe 2018 to some future date. We've shown you that there are many ways of doing that. Some of them are very complicated. It means you got to sit in front of a screen looking at all kinds of technical indicators. Some of them are very simple, like hyperwaves. Some of them are very simple, like Consensio. I've told you all along, I simplify, simplify, simplify. I don't care about the externals. I want to know what the filet mignon of the subject is. Cut away all the fat, get to the best part, and that's what I want to focus on. That's where the truth resides. So that's closed-end funds very quickly. We're now going to look at some things that will bring us up to speed on why you want to overlay things such as Consensio or a hyperwave on top of portfolios. First of all, just get a portfolio you're comfortable with. It's easy to do. Throw darts at a Wall Street Journal. That's what you just did, and you beat the pants off of the S&P. There's a little bit of trickery in that. You can figure out what it is. We'll talk about that at another time. What we're looking at now is the simplest of all forms of inoculating a portfolio. And what it is it's called an inverse portfolio. We've talked about it in other places. An inverse portfolio is designed to do opposite what the portfolio that you have is supposed to be doing. In this case, we're going to look at a mutual fund that's called the RIDEX URSA fund, symbol RYURX, RIDEX URSA. I've used it for years and years and years and years. I'm intimately knowledgeable about the people that put it together. I sponsored the current CEO, president of RIDEX before he sold out his company when he was just a young guy. He wanted me to sponsor him as a certified financial analyst, which I did. I knew his father. His father worked with me and for me at Amivest, and this guy had gotten a job down at in Maryland at the RIDEX company. Nobody had heard about them, and he was an assistant portfolio manager for a portfolio that they had that was a precious metals portfolio. And he was very smart, and he got smarter and smarter and more advanced, and began moving up in the organization, and finally took over the whole organization and turned it into one of the best mutual fund companies because it was so innovative. One of the things they did is they started coming out with inverse funds. The first one was the RIDEX URSA fund, which is what you are looking at now. We're going to put 100% of our money into the RIDEX URSA fund between the years of 2000 and 2003, which is the downturn in the stock market. And behold, your $100,000 grew to $127,000. And over that full bull market cycle, bull bear market cycle, the S&P had dropped to $80,000. The S&P was down 20%. Your return was plus 27%. You just did one fund. Now, you could have used that fund in a lot of ways. If you had $100,000 in the S&P or in your own portfolio that mimicked the S&P, or into a bunch of stocks and a bunch of ETFs and a bunch of mutual funds that sort of mimicked the S&P, all you had to do to neutralize your position, your portfolio, no matter how complicated it was. This portfolio is called the S&P 500. There's 500 stocks in it. That's pretty complicated. But those 500 stocks are all wrapped into a bundle, which is called an index, and there's an ETF that mimics that index. And there's tons of mutual funds that mimic that index. So you've taken something very complex and made it very simple into one security. You can do the same thing on the opposite with one security. Now you have two securities in your portfolio, 50-50. What's your return going to be over this period of time on that portfolio? You're going to make a couple of bucks. Why? Because the RIDEX URSA did better on the upside than the S&P did on the downside by a little bit. So you've got a zero return in a market that's just dropped 20% or 30% or 40% or 50%. And how difficult was that? Well, if you were using Consensio, it was very simple. If you happen to notice that the NASDAQ was in a hyperwave that peaked in December of 2003, you might have extrapolated the fact that, oops, this is not going to be good later on in this year for the Dow Jones and the S&P 500. So I better take some defensive postures. You had a break of the phase 4 of a hyperwave that led you to believe that some other things might not be happening that are very good. Now I'm going to relate that to our present day situation, because we've had some nominal breaks of hyperwaves, we've had some real breaks of some specific hyperwaves, and we've had the overall market looking kind of shaky. That's got a lot of people very nervous. Oh my God, what am I going to do? Sit back and relax and think about these basic principles that we've been talking about. You already know that my clients are anywhere from 35 to 50% in cash because of Consensio. We've got a 15% negative position on because of what you are looking at on the screen right now, how simple it is to throw a portfolio, in this case, a fund or an ETF, into the mix and changes instantly your entire portfolio, depending on how much you put in and when you put it in and how you put it in and all of that sort of thing. But what I'm telling you is the decision-making process of getting out of something that has been very beneficial to you into something that will protect you, and if you're aggressive, can do just the opposite. You can put all of your money in the Ridex Ursa fund and sell your one position in the Vanguard Index 500 and end up making 27% of your, on this particular case, to the downside. I'm not recommending anything to anybody. I'm telling you how powerful these tools are. In this case, because of the timing of what we're measuring, notice that the Ridex Ursa began dropping or going up in value almost instantly from the beginning of this period. And the S&P and the Ridex Ursa were flat as of August 31st of 2000. They were up 4%. Even though the stock market, as measured by the NASDAQ, was falling apart because of the dot-com bubbles. But then starting in August, the S&P began its journey lower, and the Ridex Ursa began its journey higher. Now, I will tell you that you should have gotten out of this one up in here and into this one again. But the way we're measuring this is we're going all the way to the end of 2003. December 31st of 2003. Well, the market had bottomed in March of 2003. And in Consensio would have gotten you back into this market and out of this market, so your numbers would be much bigger. Do you understand that? That's an important point. You don't have to sit and buy your positions. You don't have to trade them every day, every week, every month. That will become evident to you if you start using tools like Consensio. You don't have to calculate Consensio. You've just got to go on to TradeView or Bitcoin Wisdom or StockCharts.com once a month and throw on the moving averages. It'll take you 10 minutes to learn that. You can do it yourself. You don't need me. Or here's an idea. You can become one of our consulting clients. Okay, let's move on to the next one. We are going to look now at the Ridex Ursa in the 2007 and 2008 bear market. Now, I actually used the Ridex Ursa. I did not back in 2001, 2, and 3. Why? I was an institutional money manager. I had guidelines. They don't let you short. They don't let let you buy inverse positions. They don't let you raise cash. I retired, set up Lucid Investment Strategies right when this was happening. I had each one of my clients sign something that says, during periods of extreme market volatility, we give permission to our investment manager to take whatever steps are necessary in order to protect our assets. Therefore, I was able to, very early in the process of 2007 and 2008, step aside from what was an 80% drop in the NASDAQ, 50% drop in the S&P, and a 37% drop in the Dow. With our losses of any of our clients being no more than 8%. Okay, how do you do it? You do it very simply. Consensio tells you you've got to start raising cash. You can make a decision by looking at the chart of right X Ursa or any of the inverse ETFs. And what happened in this particular downturn is right X Ursa was up 42%, and the Vanguard Index 500 was down 34%. Now, once again, the timing on this goes from January at the beginning of 2007 to December of 2008. We didn't really get a downturn in the market until much later which starts really, let's look at the peak of the S&P, October of 2007. Back here in May of 2007, we had a downturn, some bad news, went back up. We were positive for the year, up 110,000 or 10% at this point, which is October of 2007. So these numbers are understating timing because it goes all the way back to the beginning of 07, in which the right X Ursa was underwater the whole time until October. The S&P was above water and then crossed over to the downside. If I had started this chart here, which I can't do on this particular, I could have, but then the numbers would be dramatically better. What I'm saying is how you measure things are important. I'm trying to be conservative. I just want to show you, don't be afraid of bear markets. Don't be afraid that things are going down. There are ways to protect everything in your portfolio when you define your portfolio as a liquid one, stocks, bonds, and cash. There's almost no way to protect your portfolios if your portfolios are illiquid, like in many cryptos, like in Bitcoin, where you can't the heck get out when and where you want. And if you do, you can't get your money. You can't do it in real estate. You can't do it in art. You can't do it in many facets of your portfolio life. That's why so much of your portfolio life needs to be in stocks, bonds, and cash. You are in complete control. You don't worry about the economy. You don't have to worry about the stock market direction. There are simple ways of doing very, very well, even beating the Warren Buffetts of the world, even beating the Fidelity Contra funds of the world, because they never get you out. They have to ride through the bad times. And by the way, if that's what you choose to do, they will take care of you very, very well, because there's always good times after bad times. I don't like that way of doing things, so I have come up with very simple ways to make sure that you are always protecting the bulk of your assets, which goes into one other thing that I talk about how the bulk of your assets should be invested in stocks, bonds, and cash. I believe that 60%, the vast majority, should be in wide, broad indexes that have minimal volatility and fluctuation, so you only have to make one decision, the trend of those broad indexes. I believe 25% should be in something that can grow faster and better and is more volatile, which are sectors and industries. I'm talking both stocks and bonds. You can break each of those portfolios up into what I'm talking about now. And I believe 15% should be in individual stocks or in things like Bitcoin that can give you extreme returns, but don't affect the bulk of your assets. Now, I have difficulty even with our consulting clients getting them to follow those principles because most of them come from the background of crypto, where they had a lot of money and they made a lot of money and they lost a lot of money, and now they want to branch out and understand portfolios in general, wealth and assets, money management in general. But they're coming from a background where they want to concentrate everything into very small things that are very volatile and hope for the best. Using technical analysis, my background, giving them information that I think will be valuable to them. But the tendency is not to do what I am now saying, which is protect most of your assets and speculate with a small portion of them. I do not live by that rule personally. I like to take all of my retirement money and put it into GBTC at the right time, under the right conditions, and get out at the right time under the right conditions. But I do not do that for any of my consulting clients, nor any of my discretionary clients, nor did I, in these instances, go net short the market for any of my clients. We simply used the inverse funds as a means of protecting assets that they had. Now with my consulting clients, because they come from the wild, wild west, I am showing them and teaching them that you can use these to your advantage in a down market. And in my consulting clients, we will use those to actually make money in down markets by using inverse funds. But from a fiduciary point of view, I cannot do that in fiduciary accounts. I can recommend it to consulting clients, and you can take my recommendations or not. All right, enough of that blather. Let's get on with it by looking at the last chart that I have built for you, which comes from Kiplinger, and I did it last night just to see what the heck. Kiplinger has done a good job in the past. They've used my research in changing times for their mutual fund edition, and I have followed them, and they're very good at what they do. They came out with these portfolios: American Funds New World, Barron Emerging Markets, Matthew Asia Innovators Investor, iShares Core, MSCI Emerging Markets, Schwab Emerging Markets, and Vanguard Emerging Markets. Pretty exciting stuff. And so what I did is I built portfolios going from 2007 through 2018 with those mixes equally weighted, 16, 16, 16, 16, and 888. And then I built my own portfolio out of it just to see what I could do for giggles. Let's look at portfolio number one, equally weighting their recommendations, but I went back and looked at a long time period to see what would have happened. And what we find is their $100,000 grew to $119,000 over all of those years, half approximately of what the S&P 500 did. Here is their portfolio. I said, okay, that's a bummer. Somebody must be thinking about hoping that in the future something's going to happen with this particular mix, most of which is emerging markets. They might be right. We do not know that now. How do I know that? Take a look at what's been happening. But I said, let's use this junk and let's add something to it and see if we can't clean up this portfolio over long time periods. What would you add to something like emerging markets? Well, what I would do is I would cut all of that in half and give you 8% weightings or 50%. But then I would put 25% in the Qs, which many of you would do. And then I'd go crazy and I'd put 25% in ultra technology. Why? Well, because I read Ray Kurzweil and I saw what the dot-com bubbles did. And I saw what the first 5 years of this bull market looked like. And I said, well, if we go from 2013 to 2018, which is the last 5 years of this bull market, I think just by adding two things to this stuff that didn't do anything, we could really juice it up. And of course we did. And we brought the portfolio to a position where it could outperform the S&P 500 by simply adding two things, both in the technology sector, because I believe Ray Kurzweil is right. And even though what we are seeing now is some hyperwaves in the technology sector beginning to break down. And the question is, have the one or two or three or four that have actually broken phase fours into phase fives, is that foretelling something such as we saw in 2000 when the dot-coms began to break months before the S&P and the Dow began to break? Maybe. I'm nervous, but I'm letting Consensio tell me what to do with my fiduciary clients. We started by raising 5% and then another 5% and another 5%. 5, 5, 5, 10, 25, and 50. Remember, that's what I use as my magic formula to completely get out of a trend. 5, 5, 5, 10, 25, and 50. You do that and you're 100% out. You're not short, you're 100% out in cash. Now, I've thrown in a little wrinkle real time to my portfolios by adding a 15% inverse position. And I did that because it's a very easy way not to raise cash in accounts that are taxable accounts. When you get close to the end of the year like we are, and your portfolio is shifting because of what Consensio is telling you, and you're a taxable account, what have I said from the beginning? You want your money to be in retirement accounts, not in taxable trading accounts, because then you don't have to worry about what I'm now talking about. Most of my clients are in retirement accounts, 401ks, IRAs, 457s, 429s. 403Bs. Okay, so we don't worry about taxes. We buy and sell whenever we want, raise all the cash you want to, it doesn't matter. There's no short-term or long-term gains that you have to pay. But if you're in a trading account, which some of my clients are, by putting on an inverse fund, what I'm doing is I'm neutralizing part of the long positions I'm not going to sell. My next step will be 25% more if things continue lower in inverse funds against positions that are held. That lets us at least go through January 1st, December 31st, freezing positions against market movement up and down. So I wanted to just let you know at the end of this 3 hours that to me has gone by very quickly. I'm sure many of you are bored out of your minds. But to me, it's flown by because there's so much to cover. We've tried to cover an awful lot. I wanted you to start picturing what portfolios really are, that they're not scary, that they're easily maneuvered, that you don't have to rely on buy and hold ideas that have permeated everything on Wall Street for years and years and years. And I haven't given all the reasons why it's permeated it. Let me just say that mutual funds, ETFs, and closed-end funds cannot protect you. You can't call up the money manager of a mutual fund and say, can you please raise 30% cash? They are not allowed to, just as I was not allowed to. You have to make your own decisions. You've got to override these other pre-constructed portfolios, including the S&P 500. Don't buy into the nonsense. You have to take action yourself, and it's easy to do. And that's what we will continually teach as we give you the details of how all of these things fit together. All righty then. What do I think is about to happen? I really believe that Tuesday is going to prove to be a turning point where we're going to have to either worry for the next couple of months and maybe get more defensive, or just the opposite. Starting Wednesday morning, we are slowly going to reverse all of the negativity in this market, except the damage already done to a small handful of high-flying techs that have sealed their own fate in 1 or 2 or 3 cases by dropping into a hyperwave. And once you've done that, someone has just flushed your toilet, including Bitcoins. And that's why I continue to say what I say about Bitcoin. But in terms of the markets, I believe if the Republicans hold the House, that we are going to get a tremendous year-end rally that will take us to new highs. And all of next year will be very, very positive and will turn everything around except those that have gone too far. And it's too early to tell who those are. The big indexes have not. The big indexes are struggling. I'm still working very diligently trying to figure out the NASDAQ 100 and the NASDAQ, where they come down on this whole thing. The Russell 2000 is very difficult for me to support it. I don't understand how that fits into this whole picture. So we're going to take it a day at a time, as we've been doing for the last couple of weeks. We're not going to get out of our hedges, our cash, until we see what happens. We will either add to the hedges and cash after Tuesday, or we will start taking them off. We won't take them off because we want to or believe or have faith in the future. We will do it as Consensio dictates, step by step. Be disciplined about it. When you're disciplined about it, it will take care of you. If you begin overriding things, putting your own opinions in, trying to foretell the future, you're going to find yourself getting burned. There's no need to do that. This is very simple stuff. Don't make it more complex than it needs to be. And with that, thank you very much. I've enjoyed every minute of this. And now I'm going to stretch. And, ooh, it's a bright red button. That's cool. I'm going to stretch and I will be right back. And I'm going to let Leah put some questions together, throw anything at me you would like. And I will be back in just a moment. Okay, back, and Leah is here. We are both unmuted, and hopefully we've got some wonderful questions.
We have incredible questions, as you can imagine, our brilliant listeners, and quite a lot of these incredible questions. So, Ty, I know you can speak all day. We'll try to keep this short, but we'll have some fun. You ready?
I am.
All right. So the first question was actually the first one that was put in, and it was put in by Tone. So Tone, you big man, here we go. So is it fair to use the stocks of today and go back 10 years because the stocks people choose today are stocks that people flock to because of recent gains? If people chose stocks in 2007, they might have selected Countrywide, Lehman, or Bear Stearns.
It's a great question. And I said that there's a bit of a trick to what we've done with our random portfolio. But I wanted to make sure that I never said anything to anybody to influence them. I simply said, we're going to build a random portfolio, so send in the name of a stock. I didn't say send in the name of a stock you like or a stock that has done well, but I knew that most people would pick stocks that they are familiar with that have done pretty well. And they're wondering, are they going to continue to do well? So they'll probably pick those stocks. I didn't tell them to do that. They did that. And of course, that skews the results and makes us look a lot smarter than we really are. And that was not what I intended to do, because you'll find a lot of dogs in the list that I finally put together, including General Electric. Now, General Electric was one of the stocks that people picked. There's nothing on the list of those 30 stocks that we put together that did not come from our listeners. I did not put any of those in myself. So but I knew there would be enough things like the Amazons and the FANG stocks that would show up that when added to the other mix would easily do pretty well. But that's why I varied the times. Many of the stocks, like cannabis stocks that everybody picked, weren't around long enough to be included in the list. Even things like Tesla were eliminated from the earlier lists because it started after the bear market was over. So a lot of the newer things that have done really, really well were not included. Even though people picked them, it didn't go back far enough. But that's exactly right, Tone. Any hypothetical can be manipulated in a number of various ways, which is one of the reasons I wanted to add things like FPA Capital and the Fidelity Contra Fund. It goes, back so far. Now, those are managed by people that are constantly changing their portfolios. I wanted to stress in these 3 hours that Berkshire Hathaway almost never changes its portfolio. It adds to it, but never had any technology until recently. And now all of a sudden, the biggest position is a technology company. But that was after 50 years of resisting doing anything like that. Those are important distinctions, and everybody needs to understand how all of that works. But absolutely correct, Tom.
Great. Would you use leveraged inverse funds versus non-leveraged?
Well, the question is who. When you're talking about me, I would do all kinds of crazy things. In general, people shouldn't do that, particularly in trading accounts, because there are negative tax implications of using inverse funds that are leveraged. And I'm not going to get into that. It'd take hours. But believe me, there are negative consequences to making money with leveraged negative funds, depending on when you buy them, when you sell them, how long you hold them. I'm not talking capital gains. I'm talking about distributions. Much cleaner just to use single funds like the one I showed you, right, ex Ursa, or single funds with ETFs that are inverse. But if you're from the Wild West and you want to concentrate and you want to make it quick and fast, the way to do it is with double or triple inverse funds, or double or triple positive funds. And there are not tax ramifications in the same way in the positive direction as there is in the negative direction. I'll just tell you that right now.
Thanks, Ty. What's the best and safest way to invest in an upcoming global recession to protect wealth? Question. My ideas are gold, inverse funds, and maybe splitting cash into different currencies like Swiss francs. What's your opinion? Okay,
don't assume, use Consensio. Let Consensio tell you, on gold and silver, don't make the assumption that if X happens, Y is going to happen. With any asset class relative to any asset class, regardless of what it's done in the past. We are in a new era. Now, if gold wants to go up and silver wants to go up, it will tell you, I want to go up. And that's when you get into it. You don't get into it because something else is happening that in the past you have believed means this other asset class should do something else. Let each of your decisions be proven by the underlying technicals of the price. Let price dictate to you the direction. But having said that, in general, it's very easy to do liquid assets in a negative market. That's what this whole thing's been about today. But that's a small portion of many people's assets. Real estate tends to be the biggest part. It's not always. We've got some people that have big collections of rare cars. We've got people that collect art. We've got people that do a number of other things. But they're all illiquid. And you're not going to protect yourself. You can do things like you can short REITs. Or you can buy inverse funds in the industries that relate to real estate. You can do the same thing. You can short stocks that are real estate related, the home builders. You can short ETFs that are home builders related. And we've looked at that in previous vlogs where we've looked at the home builders and inverse movements in REITs. So the way to do it though is know what your portfolio is today. That's what this has been all about. Understand what it is and have it specifically. The first thing I ask people in consulting in our second call is I shut up and they tell me what their portfolio is from their perspective. And then I'll start asking questions. What about this? What about that? Where is this? Can you move from here to there? How does this exchange work? What can you do here? Will your bank allow this? Did it? You need to do that. You need to understand your portfolio. Don't be afraid of it. Don't put it in the back of your mind or in the closet. Know what it is. And now you can take each part of that and you can apply these simple things. Cohen's sequential system, the Consensio system, other technical things if you are technically bent, or follow people that you believe understand those technical things, but apply them to each parts of your portfolio. Each stock, each ETF, each mutual fund, gold, whatever it is, and take action based on that substantive evidence of what's going on. I would love to predict what the next recession is going to look like. I couldn't help anybody with the structure we had in place in 07, 08, 09, except for their liquid assets that I had control over. That's not where the problem was. The problem was in mortgages and real estate. It quickly spread to everything else, including all industries worldwide, and unemployment surged and recession almost became a depression because of something else. But if somebody had told you that this was going to happen with Lehman Brothers, no one would be able to predict all of the fallout, where it went and how it spread, and we can't do it this time. But if you know your portfolio, you can take the action necessary for your portfolio. And but do it as it's developing for each piece, each part. Not all at once. Not your hair's on fire, sell everything. That's what people like Bogle mean. You can't time markets, and he's absolutely correct. if what you're doing is letting your emotions go from fear to greed and back to fear, all in, all out, all in, all out, triple up, 3 times X to the upside. I know what's happening. That's what gets you in trouble, as opposed to understanding 60%, 25%, 15%. Within the 15%, you take risks, but not too much in one place. Now you're in control. Now as things begin to break down, it's very simple. 60% in big indexes. You watch the indexes, 5, 5, 5, 10, 25, 50, you're out. The sectors, each one by themselves, you're either in them or you're out of them. If you're in them, that's part of your portfolio. You don't need to look at all the other ones. Just look at the ones that is affecting your life, your portfolio. Take action. 5, 5, 5, 10, 25, 50, you're out. Or you're not. 5, 5, 10, oops. 10 back out, back into the market, 5 back out, back in a bull market. Great. There was no recession. There was no bear market. It did not affect me. I sleep at night. And now I'm ready for the next one.
Thanks, Ty. With Consensio Hyperwave, time to mark sequential, we reviewed strategies for trend following and getting out of trends when they're exhausted. What strategies or investment principles do you use in choppy or flat markets?
You don't, and you don't need to. If it's flat or choppy, it's not going anywhere. Don't be afraid of it. At some point, it's either going to go up or it's going to go down. What you don't want to do, and what an investor never does, is trade it. A speculator does, a gambler does. We're in a flat market in Bitcoin now going on for months, and there are people that keep saying, oh, you missed this bounce. Oh, you missed this bounce. Oh, no, I didn't miss them. I knew they were there. I saw them. I'm not going to play them, though, because I'm an investor. I'm playing the long term. If you are a swing trader in your portfolio, then you play the bounces. You play the little moves up and down. You play flat markets. I don't wish to do that. There's a lot of hours in the day I want to be doing other things. And you don't need to do any of that stuff in a portfolio. The only thing you've got to do in a portfolio is you want to be long in an uptrend and you want to be out in a downtrend. And you can distinctly tell between the two incrementally, step by step.
How does Amazon falling out of its hyperwave fit into the whole bigger picture?
It doesn't. No one stock does. It's in its own world. And same thing with Facebook, same thing with Apple, same thing with Netflix. They're in their own world. They happen to be similar worlds, which makes me a little bit nervous. But we are finding a lot of other stocks in the same world that are doing fine, thank you. Now, can that spread? Is there a bigger message here? We don't know. So you take each piece. If you're in Amazon, you should have been getting out as Consensio told you this much, this much, this much. Hyperwave is a different thing. It's big and it's heavy and it's bold and it takes a long time and it's unbelievably accurate. But it is unhelpful in short and intermediate time periods. There's only a couple of rules. And when those rules happen and you break a phase line, things happen. And you've got to take action. But Consensio allows you, when you're way up in a phase 4 or a phase 3, way above a phase line, and you're coming down to it, it will slowly get you out of positions using Consensio. In other words, it will tell you caution is warranted. And then you're back at the hyperwave line, you're going to have to make a decision. Do I think it's going to break? Consensio says it might. Hyperwave rules say it probably isn't going to, because these things are doggone hard to break. Even the phase 2 on Bitcoin is turning out to be, I think, resilient from the point of view hasn't been touched yet, but it's coming closer and closer to the place it's going to be touched. Consensio, on the other hand, tells you different things about Bitcoin. Sequential tells you different things about Bitcoin or Amazon. So each of these tools can tell you different things, and you've got to decide how and when you're going to use those. And if you're going to do them for short-term kind of trading, you better be very, very good at what you do and have a lot of time on your hands. If you're an investor and you are in Amazon, how much should you be in? It's not part of the 60%. It's not part of the 25%. Down in the 15% bucket, it better not be 15%. It better be only a part of that 1 or 2%. So does it really matter to you if everything else is doing fine and Amazon's giving you sell signals using Consensio to raise a little money from Amazon, raise a little more? It shouldn't worry you, but that's because of how you structured your life, your portfolio. If you've got 50% of your money in Amazon, or you've got Amazon calls, or you're trying to put a lot of money into Amazon bouncing off of it, that's a different story. That's not a portfolio story. And that's the important distinction of what I've been trying to say today.
What percentage of, this is a two-part question. What percentage of fees, expenses is reasonable to pay for funds? Do you base it on past performance of the funds?
I don't care what the expenses of a fund are at all. I care about who's managing the fund and what their track record is with those expenses. Some of the best funds have 2, 2.5%, 3%. If you want Jim Simons to manage your money, you're going to pay him 30% of all of your profits and 30% and a 3, 4, 5, 6% annual fee on top of it. And he won't manage your money because he doesn't manage anybody's money anymore, because they only manage their own money because they've got so many billions of dollars from doing it. My point is, expenses have nothing to do with your final return. Don't buy into that CRAP. Just don't buy into it. It's intuitively wrong. What you want is you want net, net, net performance. How do you know net, net, net performance? Look at past performance. Look at what it's done. Look who's managing it. If it's the same person, I've shown you 3 of them. I'll show you 50 more, but you can find them yourselves. It's not difficult to do. And the last thing you want to look at is what is their expense going to be.
Do you take into account dividend policy and dividend growth concept when constructing an equity portfolio?
No, because dividend is the sprinkles on the icing on the cake. Your portfolio is the cake. The icing are the little things that come along with it. Interest and dividends are part of that. Now, if you are talking about the only thing you want are blue chip stocks that pay more than the inflation rate in dividends, and you don't really care if it's in a bull or a bear market, and you don't really care what the stock itself is doing, you want to grab that 3% dividend as opposed to a 2% inflation rate or 0.5% that you get in a CD. That's what you want. So you build your portfolio that way. Many people do that. And there's times in history that that's a wonderful thing to do. Most times in history, it's absolutely silly. Makes no sense. I don't care if the sprinkles have any taste to them whatsoever. I want to be in something trending up. I don't care about a 3% dividend. I want a 30% return compounded in an uptrend, and then I want to get out before I give any of that back. That is investing. If you are in a flat market that is not trending, it makes sense to have positions that pay interest and or dividends. We haven't talked about flat markets. You're telling me you as an investor believe the next 10 years of your life there's going to be flat markets? Then why are you talking about dividends? Put your money in a CD. You're a saver if you're playing with interest and dividends. It is the sprinkles that some people like. It's the icing that some people love. It is not the cake, which is the bulk of your portfolio.
Thanks, Ty. I'm currently 60% in cash and have bought some SPY calls expiring January 2019 in case there is a rally post-election. Is this a reasonable approach, or should we use some other strategy?
Yeah, it's very reasonable. 60 is not an unreasonable number. It's a little heavy. I'm not quite there. I'm 35 to 50 with a 15% kicker in the form of an inverse fund, just based on the things I look at. So you've arrived at about the same place. Now, that will change in 96 hours or so. So you've got calls that right now, depending on when you bought them, hopefully you bought them on weakness, which we've had for 4 or 5 months now. 4 or 5 weeks, we've had weakness, and therefore time premiums on calls are pretty reasonable. So that's an interesting structure. I think you're very safe there. You could do very well if the Republicans win and we rally, give you time to get back into positions. And in the meantime, you should have great appreciation on the call side of things. Just be real careful with your time premiums, and that you're going to get your head handed to you if the Democrats win. So it depends on how much you've got in calls relative to the size of your equity position.
Thanks, Ty. And given our crypto Wild West clients and the people that are watching for sure that are in Bitcoin, should Bitcoin be included in a long-term growth portfolio? And what is the optimal percentage weighting in the portfolio for this new asset class?
Wow, great question. I was hoping someone would ask that. Personally, if we get to where I think we're going to go, which is 80% lower than we are right now, I'm going to be looking to put 100% of my assets in Bitcoin. But that's me. The right way to do it for people that don't live, breathe this stuff 24 hours a day like I do, as I do, is 60%, 25%, 15%, and the 15% bucket is Bitcoin. Any one individual asset or stock or bond fits in that 15% piece. Now the question is, how much of the 15% will you put in there? Well, I would be recommending to my consulting clients, and I would be doing for my discretionary clients, the full 15% if we get down to where I think we're going to go. But I wouldn't touch the 25% or the 60%. Now that could change over time if Bitcoin proves itself out, but that's not going to come in weeks or months after I initially start dabbling back into it. And even at $1,000, I'm not going to put more than 25% of X into Bitcoin, because there is the possibility that all kinds of things are going to go wrong for a number of reasons. But when it starts proving itself out, and price begins telling me we could put another 25% in over $4,000, another 25% above 8,500, the last above 10,000, whatever it is, then the question is how much is X of the whole portfolio? And I would become more and more bullish about stealing from the 15% pile and eliminating other things in the 15% pile to bring my X up to 15% for Bitcoin. And then I would make the case mentally for myself and maybe for others that we can start stealing from the 25% pile if the stock market is not strong. If the stock market is still in an uptrend, a year from now, Trump gets reelected as president, where we've got a runway that's now 6 years long, then 60% has got to be over here. And the Bitcoin part, depending on what it's doing and how it's doing, will grow over time. Remember, the other thing is, if we are right, and I am right, that Bitcoin has got a great future once we get through this little thing that we're in, it will become a bigger percentage of your portfolio anyway through appreciation. And if I'm right, it will quickly swamp from the 15% to the 25% into the 60% pile if you do nothing. But that's not the way to start out. Make it, prove it. Don't hope, don't have faith. You've got the tools. Use them wisely.
Do you think you should also have an eye on limiting volatility in a portfolio along with managing risk and reward?
Same difference. It's the same thing. Volatility is a vibration that occurs between risk and reward. There's all kinds of statistical ways of measuring it. I'm not going to get into all that. But what you have to do when you're measuring volatility, it's the volatility of something against something else. And that something else can be a lot of different things. It can be premiums on options like the VIX. It can be comparing yourself to something that doesn't move very much, like 30-day T-bills, which is what a lot of standard deviations are built on, something relative to that. But anyway, what it's measuring is the up and downness of something. In other words, the size of the unpredictability of what just happens. Some things move along in a very steady pace, and some things are wild. Nothing is as wild as crypto, or as cannabis stocks, or as gold mining shares sometimes. There are things that you can pick out that are just tremendously volatile. And there's all kinds of ways of measuring that. But basically, I hear what the questioner is saying. And yes, everybody needs what I've just outlined to you with the 60, 25, 15 basically takes care of that problem for you. It's an artificial way of slapping you in the face and saying, oops, I'm getting too much. Why? Because your 15% bucket is expanding. It's 20, 25, 30. Or you don't have a 60% bucket, like a lot of my consulting clients. They've only got a 15% bucket that's 100% of what they do, because that's what they want to do. Everybody's got to decide what they're comfortable with. That is not wise investing. Wise investing is 60, 25, 15. And in that 15, you've got a number of different things. And in the 25, you've got a number of different things. You don't just have the S&P over here, and you've got utility stocks here, and you've got Amazon over here. Everything I do is widely diversified. That's what ETFs and mutual funds allow you to do without having to worry about volatility. It's automatically dampened because of the tremendous disparity between all of the parts of each of those things. you only have to worry about the one thing, the mutual fund or the ETF. But inside the pieces, the atoms are bouncing off each other. The electrons are bouncing off each other. It looks like it's total pandemonium, but that thing just sits there and slowly moves along in a trend. That's why 60% of a portfolio should be that way. That keeps you from getting crazy in these other areas. Now, if you want to be crazy in the other areas, you're going to make a whole lot more money than what I'm suggesting. You will also lose a whole lot more money. That's what volatility means.
What are the most important fundamental indicators you use to complement TA? Although fundamentals typically lag TA, what are the ones that confirm end or beginning of major market cycles?
Fundamentals? Well, you start with the biggest, always start with the biggest. The biggest is economic. And you start with the biggest economic, which is the US. So you watch US GDP. That's a fundamental. Now, that gets broken down into pieces, and those pieces are corporations and individuals, income and profits. So those are fundamentals. Where are they going? Are they going up? Are they going down? Are they going sideways? Why is that important? Because that's going to affect GDP. Then you go down lower. Corporations. Break it down by sectors. Are all the corporations in this sector acting approximately the same? Are they going up? Are they going down? Are they going sideways? Are there one or two standouts? Why? Then you go down to industries. If it's the banking as a sector, finance as a sector, take a look at regional banks. We looked at a chart the other day. Regional banks are falling apart. Some of the big banks are holding up pretty well. What's going on? Let's take a look at earnings. All of those are the fundamentals, and you keep going down until you've got the mental picture of what's actually happening. You could draw trend lines. You could play consensio games with that mentally, and that's perfectly legitimate. Those are all fundamentals, have nothing to do with price. They have to do with the guts of what goes into price in the form of what people interpret that fundamental as of doing. Do they want to buy or do they want to sell? So when price gets way above norms, PEs or price to book or price to cash flow, when it goes above norms, that's the same thing as being overextended. That's the same thing as a phase 3 or a 4 of a hype wave. It's a trend that's gone on too long. It's a bull market that's gone on too long. It doesn't mean it's going to snap back, but you need to be mentally aware of where you are in that overall picture. Now, I'm talking professional investors, not people with their own portfolios. Your question was basically about what fundamentals go into this kind of portfolio stuff. And I'm telling you that in general, 99.999% of people around the world that have portfolios don't need to think about that. All they need to do is follow the price. But professionals have got to be able to substantiate why they're making their decisions, and very few of them are in a position to be able to say, oh, because these two lines crossed. A technician can do that, and that's why there's so few technicians on Wall Street in general, but there are many of them in places that are immunized against outside criticism, like hedge funds. The most, like a mutual fund, you cannot call up the mutual fund manager and ask him what he's buying and selling. You can't find out what's in your mutual fund until 6 months later. Nobody's going to tell you. You can't find out what they're buying or selling. They're immunized against that outside criticism. Well, how did you make that decision? What fundamentals did you use? Oh my God, you're using technical analysis? I'm going to take my money from you. They do it, but they're not going to tell anybody they do it because it's voodoo science. So anyway, that's how I look at fundamentals. They are unimportant unless you're an economist or a professional investor.
Insights on hedging currency exposure for non-US investors that are using United States dollar as the main currency of their portfolio.
Yeah, currency is a little more than the sprinkles. It's more the icing. And in some cases, it can actually take bites out of the cake itself, because some of these swings are dramatic in Turkey and Venezuela and Argentina. If you take a look at long enough charts of dollars versus euros or other currencies, and we've done that in our vlogs. We've looked at 100 years, 80 years of currency prices, and we've seen the dollar fluctuates within a range, back and forth. And the shorter the time period, it's not a bigger range, it's a smaller range, actually. It's only at very key turning points where something on a macroeconomic shift is taking place that I think you have to worry about currency translation. Now, businesses have to do it all the time when they're going cross-border. And if you've got assets in a half a dozen different places, then currency starts running into problems. In terms of your portfolio, if you're buying things designating US dollars and you're having to switch out of a local currency to do that, I wouldn't get all wiggly about it. It's not going to be that big of a deal unless it starts getting to be a big of a deal. And if it does, if it starts bothering you that you've given up 2 or 3% of potential gain over the past 12 years because of the stupid currency problem, then you might buy an ETF in some amount that is in your currency or respects your currency, or an FX position. To me, it's a bit of a bother. And if you're more interested in the long-term movements of things, which is where 90% of all gains come from, I wouldn't get too hung up on that. But I understand there are times when you need to.
Follow-up question to that. I'm a non-US investor who doesn't have the same access to United States markets as others. Would it still make sense to focus on US equities, or should I invest in my own country's stocks, etc.? Or is this decision solely dependent on consensus? The last part is, plus how can a foreign investors invest in the United States market?
Yeah, unfortunately, we've got not unfortunately, very fortunately, we are very pleased to have clients in 17 or 18 countries now. And in each one of those, I've had to work with them about finding out what they can buy and how they can buy it. And it differs country to country, so there's no quick answer. In general, you will find that there are ways to buy US securities, either through big platforms like Fidelity or Schwab, which uses a lot of Invesco stuff, which is an international firm. We find that Interactive Brokers is very generous in what they offer to anybody where you've got access to it. So some of the electronic ways of moving money work very well for all of the things that we're talking about. So I can't answer that generally because it depends specifically what country you're on, and you could just put that, let us know, unless you're one of our clients, and I know already, and you and I've been struggling trying to work out the details of that. But in almost all cases, we found we can buy anything we need to build the portfolio properly or change a portfolio that exists across borders. I'm not saying it's perfect. It's far from perfect, and a lot of places are very bad. Most places are pretty good. But there was another part of that question that had to do with should I just stick to stuff in my own country? Yeah, You should, but, and let Consensio tell you, you know, just because your country's economy and or stock market is doing better or worse than the U.S., if it's doing better than the U.S., and it might have been recently, probably not, but if it is, great. You should be seeing upticks on Consensio saying you should be adding money. It's just that I've been so adamant about the U.S. market because it's just blowing everybody else away and has for the last 8 or 10 years. The reason you don't see any international stuff in the portfolios I showed is because they all detract from returns. It's that simple. Now, that's an unusual period, and very unusual. And we saw that we are beginning to see some emerging markets like Brazil begin to do stuff. If you happen to be in Brazil, I'd have a whole lot of money invested, and then you get into the currency problems. So we can make this as complex as we need to, or as simple. Let's keep it as simple as possible. Use Consensio wherever you can use it. Use these money management skills and portfolio building wherever and however you can. If there's ways to optimize it by getting to move into other things that you don't have quick access to, try to figure it out, and we'll try to help you out, figure that out. But there's plenty to go around.
Thanks, Ty. And that viewer just said that they're from South Korea, so the fun Kospi.
Oh, great.
Does it make sense to dollar cost average and buy mutual funds ETFs in small amounts each month?
Yeah, dollar cost averaging is a wonderful, wonderful, easy system. And that's why retirement accounts are so great, because it forces you to dollar cost average. And over time you see, wow, this is wonderful. I love it when the market goes down, because I keep buying every month at lower and lower prices. I'm getting more and more of the same thing. And then when the market goes back up, I've got a ton of this stuff. And it's because you haven't put too much in at one time, which is the whole 60, 25, 15 thing that I talk about. Is if it's very clear what the trends are, get all your money in now. If it's unclear what the trends are, or if the trends are going against you, dollar cost average, meaning if trends are down, it's a perfect time to dollar cost average, little at a time. It doesn't make sense to dollar cost average in a 10-year bull market. Put it all in at the beginning, everything you got. Now, you don't know it's going to be a 10-year bull market, but you do know that Consensio will get you out before it becomes a bear market. But if you're in a bear market, dollar cost average, a little bit at a time. So people say, well, Bitcoin's in a bear market. Shouldn't I have been dollar cost averaging? Yeah, but not the way you're talking about it. You're talking about putting all your money back in Bitcoin. If you've got $100,000 to put into Bitcoin and you were lucky enough to get out early, then putting $1,000 a month into Bitcoin makes sense. 1,000, not 100,000, not 50,000, not 25,000. It's in a bear market. It's going lower. Don't put a lot of money in it. But you can put a little bit at a time in, and at some point you're going to get to wherever it's going to go. Let's all hope it's my phase 2 line. We break it next week, the week after, a month from now, 2 years from now, we break it. We go down, we hit Tone's number, we go down, hit the Fibonacci, we come back, and we're off to the races, and it's over. And maybe that occurs this week, this month. Who cares? Don't guess. There's no reason to guess at these things. No reason to get your ego in the way. Ooh, I know better than he knows. Just take it easy. Go slowly and use these tools. They will not let you down.
So let's do a continuation of Bitcoin onto GBTC. If GBTC is precursor for Bitcoin, it just went up 4.73%. It's a comment.
Yeah, it did. And I'm impressed with what I've seen since GBTC 3 days ago hit new lows. Remember, GBTC hit new lows 3 days ago. So is it going up or down? Yeah, it took a little pop. but it's a reasonable pop because it's happening right where Bitcoin is trying to hold on for dear life. If we see, but remember, what's the main trend of GBTC? Lower lows. What's the intermediate term for GBTC? Lower lows. What's the trend of GBTC? Down. Don't mix up short-term pops with intermediate or long-term trends. When I say that GBTC leads Bitcoin, I don't mean minute by minute, day by day, or pop by pop. I'm talking about trend changes, trend moves. That when GBT's premium is growing and it is moving up faster than Bitcoin, that is a bull market. When GBTC's premium is diminishing and Bitcoin prices are dropping, you're in a bear market. We're in a bear market. Don't get sidetracked by GBTC. Now, if GBTC continues to climb with Bitcoin not moving, that means the premium is going to increase from being down at 0, which it hit. People were all over me because I said it was at 10%. They said, no, it isn't. No, it isn't. It's at 20%. Then they started saying, no, it's at 10%. It's 10. Oops, it's 5%. You can calculate it in different ways, but the point is that the premium went completely out of GBTC. Now, if it begins to grow without Bitcoin dropping down, not for a couple of hours or a couple of days, but for the next couple of weeks or months, that's beginning to tell you something very important because it's fighting two battles now. One is that it's made up of Bitcoin, but secondly, that it's fighting off the future in terms of other ETFs. It makes no sense for institutional investors to buy into GBTC, causing the premium to go up, knowing that as soon as an ETF is approved that has no premium, it's going to go immediately to 0. So it's either a very short-term pop or somebody doesn't understand exactly what they're doing or they know something about what's coming down the pike or not coming down the pike in terms of competition. They might be saying, I know it's not coming until next March at the earliest, and I think we could get a pop in Bitcoin before the end of this year, back up to some number, 7,000 or 7,500, and therefore I'm willing to put money in even though I could lose it overnight if I'm wrong about this ETF. So that's a well thought out argument. They've sharpened their pen and they say, I'm going to give it a whirl. But to me, at this point, that's all it's saying.
So we have 8 minutes left, Ty. To start off building a portfolio, would you recommend picking the S&P 500 like funds outlined today, or would you go even further and using individual funds for each sector?
I would start with the 60%. If you don't have a portfolio built and you're sitting on cash, I would start with the 60%, which are all broad indexes, broad funds. They don't have to be indexes, but they're broad funds. Broad meaning they've got hundreds and hundreds, at least 20 or 30 or 40 or 50 stocks, which are called focus funds. And then you got to be sure the manager of that fund really knows what they're doing. And there are some. Tennessee's got a 2020 focus fund, which is great. A bunch of places do. But if it's a broad fund, meaning 50, 100, 200, 500, 600 stocks in it, that's the same as an index. It's just that you got somebody sitting over it that's making those calls, making those moves. So that's broad enough to be in the 60% piece. That's where you want to start. You start with the biggest thing you're doing, the biggest, longest trend line, the biggest trend, the biggest economic macro issues, and then you work your way down to the smallest pieces. Take care of the big stuff first. But Consensio says you should be half out of the market. So on your 60% piece, you shouldn't have more than 30% in today. 4 weeks ago, you should have all 60% in. Today, 30%. So Consensio overrides everything, including building a portfolio. You don't take 100% of your market on a random day and put it all in, and then all of a sudden realize, oh, Consensio says I should only be in 80%, and you've got 100% in, now you got to get back out again. So you build it relative to the tools that you're using. If you're using the sequential system and you've got 20 stocks or 20 indexes and you're building your 60% piece, you want sequential to tell you when to put it in. You don't want to put it after it's been going up and it's hitting a 9 and a 13 and there's going to be a pullback. Wait for the pullback. And that's when you start building the portfolio again. So it's never all or none. Even though you get excited about some of the concepts, put them all together and do it step by step so that you're ready to go no matter what happens in the news, no matter what goes on in the world, no matter what happens out there, it doesn't affect you. You're in control. And you can stay in control for the rest of your life. And you can learn more and more and more, but you don't need to. These basic principles are all you need to take care of your wealth in your portfolios.
Follow up on Consensio. Will getting in and out of using Consensio, raising up to 25%, step 1 through 4, along a bear or a bull, along a bull or bear run, not reduce our overall performance?
Yes, absolutely it will. That's the point. That's what you want to do. You want to take some of your performance in the form of a premium and buy insurance with it. So when the house burns down, your policy pays for your house. That's what Consensio allows you to do, getting into or out of a trend. You give up upside by being late into an upside trend. You get out of downside as quickly as you possibly can by putting on inverse funds or raising cash or just selling what you've got. Now, that means if Consensio is not predicting a downturn out of a bull market, such as where we are sitting right here today, waiting for Tuesday, we have spent money in terms of commissions, if there were ETFs, to sell, to raise cash. That is your payment of a premium for an insurance policy. We did it again and again and again to the point that we've got about half the money out, which means if Consensio is accurately predicting that this is going to get worse and worse, half your money is safe already. If we turn to the upside, you've just paid a premium on buy, hold strategy. If you had just not touched anything, and we'd gone from a 10-year uptrend to a 1-month downtrend where we raised cash back into an uptrend, that little blip cost you performance as opposed to just saying, shut up, Tyler, I'm going to do what John Bogle says, I'm going to buy and hold forever. Except when you turn down. We prove that over and over again today by looking at what happens in down markets and how quickly you get your premium back and then save your principal and then start making a lot of money that you wouldn't have made otherwise. That's the way the whole thing fits together.
Last question. Given the best traders in the world are not able to beat the performance of the S&P 500 over the long run, with a few exceptions, couldn't we save a lot of time in portfolio management by just buying and holding, dollar cost averaging a low-cost S&P 500 ETF?
If you put Consensio on top of that, yes. If you don't, no. everybody that uses what you have learned today will always beat the S&P 500 forever and ever and ever. Every one of you. Forget all that nonsense about the number of managers that do and don't. It's the easiest thing in the world.
Well, that's perfect. With 1 minute to go, Ty, do you have any last statements to make?
No, just thank you very much, everybody. Thanks for the great questions. Thanks for putting up with all of this. I hope you've learned something. I know I have, putting it together. It's great to constantly remind yourself what these principles mean. And if it's just theoretical, it's easily lost. When you get it down and actually look at actual numbers and really think about what's going on, it's great support. So thank you very much. We've enjoyed it, and we will be doing more of these.
Thank you, guys.